market close at NDTV Profit. I am Mahima Vachrajani and with me is Neeraj Shah. Well, before we move on to the different elements that are planned out for you on the show today, let's take a quick look on how the markets are doing. The Nifty 50 down by about 0.6 odd percent, trading within that range of 200 odd points. The Nifty Bank also down by about 0.6 odd percent. The Nifty Bank down by about 0.8 odd percent, majorly dragged by Kotak Mahindra Bank on the back of its earnings. The Sensex also down by about 0.7 odd percent. Let's try to pull up the Nifty heat map and see what counters are doing in trade today. There's Shriram Finance with stopping the chart up 2.6%, followed by Cipla up 2%, Hero Moto, Grasim, SBI Life. Some counters doing well in trade today, but some counters facing pressure. Kotak Mahindra Bank, the biggest loser on the Nifty 50 today, down by about 7.4 odd percent on the back of its earnings. Wipro down 3.6%, Bajaj Finance down 3%, followed by BEL, Bharti Airtel, IndusInd, Titan, Nestle, all down by about 2 odd percent. Let's also try to pull up the advanced decline ratio and see what is the broader end of spectrum looking like. Well, it's as wide as a crocodile's mouth. There's 473 odd advances versus that of 1800 odd decline. So the market's clearly on the sell side today. Let's also try to pull up the sectoral heat map and see how sectors are doing in trade today. It's only the Nifty Pharma in the green today, up by about 0.5 odd percent. Nifty FMCG slightly in that green, hovering here and there, but Nifty Realty under pressure, down almost 3.6%, followed by Nifty Media, where profit booking is seen. Nifty Defense, continued profit booking seen there as well. Nifty Private Bank down 1.7%. Nifty Metal down by about 1.2 odd percent as well. Nifty Bank again seeing that beating of around 0.8 odd percent. But Neeraj, I come to you on this one. How are the broader markets doing?
Yeah, I mean, there is pressure for sure, Mahima. So suffice to say that there is quite a bit of selling that's happening, and this is not just retail selling getting absorbed. I think there is fair degree of insti selling that seems to be the case in the session today. I'll start off with some losers, and beyond the Nifty, I think there is weakness today in SBI Cards, for example, down 5.5% after the results and the brokerage downgrades. You're also seeing some bit of pain happening in Zen Technologies after the results have looked wobbly, and that stock has come off. Mahima highlighted how real estate has looked weak and is amongst the top sectoral losers. Lodha, DLF, Marathon, that list is looking fairly long in terms of real estate stocks that have cracked in the session. Almost everything has looked slightly wobbly in trade. On the flip side, some bit of value buying being seen in Chennai Petro, for example, today. Remember, on the day of the results, the stock cracked about 7%. In today's session, it's bounced back very, very smartly for itself. Acme Solar has done very well for itself. There is strength in e-clerks on the back of the management commentary. Emphasis has done well from among the IT packs, so a bit of an outlier there. And Paytm also does well today. So yet another day when Paytm is up in the green, about 2.5% higher for the stock, 1094. This is in and around the levels that it was on the day of the results, or the day after the results rather, when it first reacted to what was a reasonably strong quarter. Okay, let's get in chart checks going to start off the show. By the way, as we speak, Q1 earnings up on the screen as well for TCI, but as you can see, a 17% uptick in net profit. Nothing dramatic. It doesn't bring about too much of a cheer on the street. Hemen Kapadia of DR Choksi FinServe, excuse me for the fly, joins us on the show. Hemen, good having you. Thanks for joining. Good afternoon. How are you viewing this? I mean, this has been now a number of days of pain, Hemen. Are we reaching a point from wherein a bounce back could be imminent or not quite?
A very good afternoon to you, Neeraj. Thank you for having me on the show. So it's a pleasure. I think I agree with you because we took 7 weeks to break out from a 700-point range. We gave a 300-point move, which flopped, came down, gave a recovery, couldn't overcome 25,200, flopped again. And now we are going to 24,500. Levels were 25,002, 24,792, and 24,492. That's 24,500. So the rate at which we are going, if it comes there tomorrow or day after, maybe tomorrow, I believe that's a very significant support, and I would go with you. I think it's getting oversold. Chances are we are going to give a decent bounce from here. So maybe we are preempting it, anticipating a day early. But yeah, at 24,500, I would stick my neck out and say I'll keep a 100, 150 point stop loss and go long, because I think chances of a reversal, I'm not seeing a reversal of trend, but a decent bounce seem pretty high, Neeraj.
Okay. Heyman, hi, good afternoon. What about Nifty Bank? It's largely backed by Kotak Mahindra and IndusInd, which is expected to post its earnings today. But those are the top two losers on the Nifty Bank today. But your sense on what is the kind of support and resistance that you're seeing on the charts?
Yes, Mahima, if you look at the Bank Nifty, we spent 6 weeks. There's a sixth week where we've done nothing. It was the strongest. It made a new all-time high. Thought we would carry on the momentum and traction and go towards 59. Now that's not happened. Having said that, in terms of support, 55,961 in Nifty spot is important support. We are almost there, 55,961. So if that breaks, then we could slip another 500-700 points. Now we'll have to wait and see what happens. There's also the 55-day exponential moving average over there beside the normal support, Mahima. So I believe this is a significant level. And if Nifty reaches 24,500 tomorrow and Bank Nifty doesn't break 55,961 decisively, I'm not talking about intraday breach, I'm talking about a closing close, then chances are that we see some respite there. And with Nifty bounce imminent, I think this could also sort of salvage the situation. But normally when the Nifty breaks, IT saves it. This time that's not happened actually. Mahima.
Okay. And your top picks for the day, Heyman?
I would avoid giving picks today, Mahima, because too late to sell, too early to buy. I'm not sure that if the Nifty has come off from 25,650 to 24,650, it's already 1,000 points, Mahima. I'm not saying it's not going down. Intraday sales are there, but positionally, I wouldn't be comfortable shorting the Nifty when we are very close to 24,500. And if I give a buy at this point in time, stop loss is going to get triggered in 24 hours. So I'd refrain from giving a call right now, but at 24,500, I'd go long on the Nifty itself with a 150 point stop loss. Mahima.
Achima, I mean, can I ask you a follow-up question? And fair call, you don't want to do that. But there are some stocks which are either bouncing back or some stocks which are continuing their uptick, and I want a view on both. So one of them is Chennai Petro. Fell off after rising all the way to 800 on the back of weak results. But this shows that there is some buying that has happened today. If you were long in Chennai Petro, would you stay long?
This current small recovery seems more like a bounce, Neeraj. So if I was long, I'd probably book profit if I was in the money. And if I wanted to hold on, I'd keep today's lower the stop loss. But I think it's going to take a little bit of consolidation before it recovers. So not very comfortable at this point in time.
The other thing is, if you were long into a Laurus Labs, would you book profits now? It's been a one-way incessant rally all the way to 900 now.
I would. We are very clearly, without any rocket science, Neeraj, in a short medium. It's in an uptrend on all time frames, short term, medium term, long term, long term. So no rocket science over there. But looking at the quantum and the speed of the move, everything is hunky-dory, everything is fine. But even then, I'd book some profits, because the stock moves from 570 to 901 in what, 4-5 months. I'd say one shouldn't get too greedy. There would be some time price retracement sometime down the line. So I would book profit. There's no question of shorting it, but I would book some profit.
Okay, what about something like Paras Defense? The earnings came in during market hours on Friday, and it's seeing a tank. It's locked in lower circuit as we speak. It's down 10%. Any view on the charts for this particular counter, and anything that you're liking right now in the defense space, because it's been correcting for quite a while now?
Frankly speaking, 770 was an important level after the split of the stock, Mahima, Paras Defense. So currently that's broken, and what seemed like a possible consolidation, that was around 7.5 weeks, Mahima. Now that has broken with a bang. So I'd wait. If I were to buy, the next support level is 660 and 580. I'm not sure if it goes to 580, but if it does, rock solid. That's where you would sort of buy. So in terms of defense, I think most of them, whether it's HAL, Cochin, or Mazgaon, all of them have been humongous multi-baggers. I think the laws of gravity needed to catch up with them. That's happening. But if you have a 2-year view on a decline, I think they are all a buy.
Okay, Heyman, thank you so much, for giving us those insights, and thank you so much for taking out the time and speaking with us at NDTV Profit.
Thank you.
All right, now, shifting focus and, talking about IndusInd, because most of the banks have come out with their earnings so far, but IndusInd is yet to announce its earnings, and it's going to come out with its earnings later today, and Hiral joins us with what to expect from this particular lender in terms of its Q1 FY26 numbers. Hiral, what are you picking up?
Overall, if you see, thanks Mahima, the stock has been under pressure ahead of the numbers. It's trading near the day's lowest levels as we speak. The key question over here is IndusInd Bank actually returning to profitability this time around after posting a loss in the fourth quarter of FY25. The profit, however, is expected to dip by around 70% and come in at 653 crores. NI is expected to see a dip by around 14%. Your net interest margin, that number is seen at around 3.57%, which is higher versus a 2.25% if you have to compare it on a sequential basis. And the provisions are expected to go up by around 36%, and that number is seen at around 1,424 crores. Now, apart from that, if you talk about the business update that they gave in, it was slightly weak at that point in time, where the advances were down 4% on a year-on-year basis and down sequentially, and similarly, deposits have also seen a degrowth on a sequential basis. However, they have remained flat on a year-on-year basis. Talking about the pre-provisioning operating profit, that is expected to come in lower this time around. Credit costs probably could remain elevated as well, because in the March quarter, that number was around 2.8%, and overall, an easing of around 90 to 100 basis points is what is on the cards, but still that number will be elevated. Gross slippages, there could be some bit of a decline that could be coming in there, but again, that number is going to be elevated. Net interest margins as well, we already spoke about, so that's going to be a monitorable. Apart from that, the progress with regards to appointment of the bank's new MD and CEO is something that the street will be watching out for. The guidance in terms of the bank's pace of net interest margin expansion is what the street is eyeing. The MFI asset quality as well as the growth trajectory are few of the key monitorables that the analysts and the street are watching out for so far. But clearly, a number that the street is closely looking at, because overall, it's the derivative mess is what will impact this quarter.
Okay, thank you so much, Hiral, for breaking that down for us in a detailed manner. To take this conversation ahead, we are joined by Ashutosh Mishra, who's the head of institutional equity research, joining us now. Ashutosh, hi, a very good afternoon to you.
Hi.
I'll take this up. Hi, good afternoon. I'll take this up with you. What are your expectations with respect to where the business growth stands for IndusInd, and overall, how are you viewing the entire quarter shape up for the company?
So business growth will be muted in this quarter. We all know that because of the implementation of the guardrails, MFI books across the sector, both in NBFC and banks, are coming down. So this will be case with the IndusInd Bank, and they have a fairly large MFI books also. So because of that, we will be seeing the business growth remain muted for them. And the focus at this point of time is not about the business growth for the banks. Focus is about how they are able to defend their liability franchise because of the concern which was there. Are they able to do that effectively? That will be the main thing which I will be watching out for, if they are able to do it. And then who will be going to be the next MD of the banks, and what is his vision and going forward, that thing. And third will be to see that on a credit cost point of view, is there any incremental pains, because they have taken very large write-offs in the fourth quarter. So whether all the pain has been addressed, and how the credit cost will be setting out for the coming all 4 quarters of this year.
Okay, Ashutosh, what about the kind of outlook on fresh slippages, recoveries, etc.? What's the kind of view on that, the operational metrics?
So we are going to see an increase in the slight increase. Sequentially, it will be decreased, but year on year we will see increase in the fresh slippage. Just two part of the portfolio which they have, commercial vehicle as well as MFI, which are under slight stress. We all know that other players has also reported that part of it. IndusInd is also there, but they have taken a very thorough cleaning up in the fourth quarter, and management has indicated that almost all the account which were any of the problem they have recognized in the fourth quarter too. So that's why what we are clearly seeing that on a sequential quarter basis, this will be improvement on a quarter-on-quarter basis. So nothing much to worry on that front, but yeah, how the things has progressed for these two portfolio will be important to watch.
Okay. What are your expectations with respect to where it comes to your net interest income? Analysts are suggesting a growth of around 24% on YOY basis and 34% QOQ basis. Do you also agree with this kind of number?
Yeah, broadly it is in that, and it is very hard to project also on quarter-on-quarter basis then NI, because there was a large reversal of the income in the fourth quarter. So if suppose some more account goes to NPA because of this two sector which they have a fairly large presence and is under stress, then we may see a disappointment on that front. But otherwise, I don't expect on NI front any major disappointment, and my numbers is also in line with the industry estimates.
Ashutosh, the other quick question that comes to mind is that if IndusInd can't deliver a surprise, but if they show chinks in the armor, this small bounce back that we've seen from those erstwhile lows, is there a possibility of those being revisited, or are those days a thing of the past?
So if you look at connect the dot last few months, the way things are panning out, like RBI has allowed Hindujas to appoint two more board of director. We all are buzzed with this is his name of now MD and CEO who is going to come up there. If you look at the business model of the IndusInd Bank in a declining interest rate scenario, they are very well placed. So I don't think any major correction in the stock from here. If clarity came and the current valuation at which it is trading at, probably some more upside can be from here.
Okay. Okay, Ashutosh, thank you so much, for taking out the time and giving us those insights. We'll have to wait and watch out for as to how the earnings pan. It'll be an interesting set of numbers to watch out for. As Hiral was mentioning, net interest income is expected to see a growth of around 24%, operating profits at around 41%. This is YY basis, and overall provisions also expected to see a good rise, but advances will decline around 3.5% and deposits will remain flat as the kind of expectations right now. But sticking with the banking space, Tamilnad Bank is another counter which is in focus, came out with its Q1 earnings. The stock is down 1% as we speak, but to take this conversation ahead as to how the quarter is panned out and how FY26 is shaping up for the bank, we're joined by Selly S. Nair, MD and CEO of Tamilnad Mercantile Bank, joining us now. Mr. Nair, very good afternoon to you. Before I move on to company specifics, I just want to get a sense overall, your view as to the way the entire quarter is panned out. What were the hits and misses according to you?
Yeah, thank you for having me on the show. The quarter has been a quarter of stabilization. I think that's how I read it, because when I look at some of the numbers that we have delivered, particularly the business, I think business growth is something that we have been trying to push for some time. And deposit in particular, when we look at it, year on year, particularly the deposit side, the pace of growth, we have nearly doubled. It was 4.64% in the first quarter of last year. Now it is at 9.38%. So we are trying to push the growth back into the deposit space without impacting significantly on the advances side. Advances also, if you look at it, the growth year on year is 10.44%. I think so. Both the deposit and advances, the first quarter, very clearly the bank has delivered, and that gives us the confidence that typically first quarter is the quarter where a lot of disruption happens, and a lot of disruption particular to GMP, because we have put in place a lot of initiatives, particularly on the IT side, which is sapping some kind of a managerial bandwidth in that towards that. And despite that, to deliver this kind of a number, this kind of a growth on the business side is something quite satisfying for us and gives us the momentum to look for an accelerated growth in the coming quarters. I think on the other side, when you look at the financial performance itself, the profits, I think we have delivered 6% plus of profit, and that too after upfronting, what we call performance-based incentive that normally we amortize it across the year, across the quarters. We have taken the whole thing, we have upfronted the whole thing in the first quarter itself. So that is 41.27 crores that we have taken. If you look at the first quarter of last year, the amount was just 8.74 crores, which was essentially it was amortized across the quarter. So that is something that we have taken upfront. And that, if you look at it, has impacted the operating profit, but I'm not worried because, and also the net profit, like I said, this is something that, should do us good in the coming quarters. The confidence for taking this upfront came from the fact that our slippage ratio was just 5 basis points. We were able to contain the slippage ratio to just 22 crores. So that, which means the credit cost came down to just 6 basis points. So that gave us the confidence to take the PBI, the cost of PBI upfront. So 6% plus profit on the riding on the fact that we have upfronted the cost and the growth coming back, and which should see getting accelerated in the coming quarters, is where my satisfaction on the first quarter performance comes from. Yeah.
Now, good afternoon. So can you give us some color on that particular piece, which is the kind of growth that will come in for the next few quarters?
See, we are doing a lot of initiatives on the MSME space. If I'm looking at the advances first, a lot of pieces on the MSME space. We are looking at appointing a lot of relationship managers, credit analysts. And apart from that, in the first quarter, we spent a lot of effort and bandwidth in training them and getting them skilled in managing the portfolio. Apart from that, we have also we are also putting in place a platform, a tech platform, a loan management system, which and also a BRE, business rule engine. Incidentally, the business rule engine is something that we have already completed. The risk modeling that is embedded in the BRE has been validated. Now we are in the process of getting that embedded into the LMS, the loan management system. And the loan management system itself, the implementation is on, and the phase 1 should happen by September, I think, sometime during September. And the skill set that is being developed and the technology put in place, I think should give us some real growth on the MSME, even in the second quarter and certainly in the second half of the current year. So, and we are also already seeing that, the relationship managers panning out, the credit management centers that we have put in place in Thoothukudi on a pilot basis, and, on the leadership that we have appointed in the other regions are already having an impact. First quarter, I may not have a significant growth, or it's almost a flat quarter as far as MSME is concerned. But from June itself, I can see the numbers moving up in terms of a healthy pipeline. So that gives me the confidence. The second quarter, MSME is going to do well. And going the second half, I think that should get accelerated. Incidentally, we have, our own, apart from the retail, we do have a sizable loan under the jewel, what we call the gold loans. I think that's about 40% of the book. And that's also delivering us some good results. And the yield, from that is quite substantial for us to maintain, improve on the yield, the NIM as I see it going forward. So both your gold loan holding ground and the MSME getting back into shape, and the retail. Incidentally, we have also sourced a new loan origination software which is aimed at the retail segment. So all the three firing, which I expect to happen more in the third quarter, I think we are looking for good times on the advances side. And deposits also, we have taken quite a few initiatives. If you look at it, last year, we have seen a slide in the CASA ratio.
Right.
It was almost 3%. And the first quarter, I did mention to your viewers and to the investor community at large that several initiatives are being undertaken in the deposit side, particularly focused on CASA, where we put in a transaction business group.
Right.
And in the first quarter, we also launched our elite services group.
Right.
So that these two combo is sort of beginning to show some results, and that is where I see a year-on-year growth of 4.51% against the negative growth last year. So even the CASA, I think, beginning to show some results. And the CASA share, as I speak, I think it is up 34 basis. So from after hitting 26.44%, it is up 34 basis. So I think some confidence is coming back to us in that performance in the CASA, and the term deposit always has been generating some growth.
Right. Got it, Mr. Nair. Got it. Thank you so much, for giving us those detailed answers, and thank you so much for taking out time and speaking with us at NDTV Profit. Now, shifting focus slightly, important update from Jammu and Kashmir. 3 terrorists have been neutralized in a high-stakes encounter on the outskirts of Srinagar in a joint operation dubbed Operation Mahadev. The Army, CRPF and J&K police launched a swift offensive in Lidwas and acting on precise intelligence inputs. My colleague Shiv Arur joining us with more details on this.
What the Indian Army appears to be doing as part of this update is, it says Operation Mahadev update. 3 terrorists have been neutralized in an intense firefight. Operation continues. Very, very interesting. Let me decode what this means. 3 terrorists being killed. We are hearing categorically from the ground and from the J&K police that these are HVTs. HVT means high-value terrorists. What does high-value terrorists mean? Terrorists who have been definitively linked to previous terror attacks or have been pursued by the security forces for a significant period of time, who have a bounty on their heads and who have been evading the security forces, for a while now. We don't know just yet. This is all very tantalizing because it comes 3 months after the Pahalgam terror attack. It has been one of the most grueling and difficult terror hunts by the security forces, a blend of the Army, the CRPF, the J&K Special Operations Group and others, including the intelligence agencies and special forces. We are awaiting a categorical confirmation now on whether these HVTs, belong to the Musa gang of the Lashkar-e-Taiba or the TRF. I hate calling them the TRF because they are, after all, the Pakistan Lashkar-e-Taiba that were involved in this particular terror attack in which 26 people were killed. So the next step after a confirmation of this kind would be the identities of the terrorists, which group they belong to and which terror attack they were responsible for. Whether they are the Pahalgam terrorists, we will know once the Army confirms.
Thank you, Shiv, for breaking that down for us. But with that, it's time to slip into a very short break, but we'll be right back on the other side, so do stay tuned.
हेलो बोलिए मैडम, डब्बा टेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research.
Welcome back. You're watching India Market Close, and it's that time of the show where we get you all the chatter from the dealing room. I don't know if the chatter's turned into a whisper, considering that the market mood is quite muted. Samit, what are you hearing?
Well, the market mood is quite muted, but there is stock-specific action that we always see. And today, firstly, it's SBI. Dealers are indicating that there are buy flows on institutional desks. Both foreign and domestic institutions have been buying this counter at lower levels. The price also, if you look at for SBI, it's way below the QIP price. The bank had raised around 25,000 crore at 817, and the stock is now trading below 800 rupees. Second stock on the list is Cartrade Tech. There are buy flows on large HNI desk, and this has been triggered after the company's strong management strong commentary that has come in on order wins. So the outlook for order wins is quite strong, and that has triggered this rally, and HNIs have been lapping up this counter. In fact, if you see at the opening trade, the stock was just up 1%. It is after 10 a.m. that we have seen such kind of spike when it comes to Cartrade Tech. Second stock on the list is GAIL. Now there are high sell flows on this counter, and dealers are anticipating that most likely the numbers will be pretty much in line with what the street was estimating, but there could be a cut when it comes to the volume guidance number that the management has given, and that's the reason the stock is down 1.5% before the numbers. For Mankind Pharma and Exide, there are sell flows on institutional desk in trade today in anticipation of weak Q1 earnings. Godrej Properties is another stock that has been under pressure in trade today on anticipation of a block deal. Now, a foreign investor who had put in money during the QIP, which was done a couple of years back, will look to exit, is what dealers are indicating. Hence, the stock is down 5% in trade. And lastly, when it comes to Lakshmi Dental, Bharat Rasayan and Hind Rectifiers, dealers are indicating that there are buy flows on HNI and PMS desk in trade today.
Okay, so stock-specific action is where it is, and where actually the action is so negative that you should hope for some stock-specific action. And Kotak Mahindra Bank is the big shocker. I mean, I know the numbers and the commentary was a little negative, but I don't know if it deserves a 7.5% hit down today. Same likewise for Lodha. Otherwise, on the face of it, seemed like good numbers. The mood has turned a bit somber, Neeraj.
Yeah. And maybe in Kotak's case, it's got to do with the fact that when the update came in, the stock really zoomed in trade. So is the market given an equal and opposite punishment now that the quarter is looked weak? But yeah, buy your point on Lodha, buy your point on a lot of other stocks today. The only question is, Tamanna, are we coming to a point wherein the risk reward is not in favor if you go short from the current levels? I mean, let's figure that out with our experts on the show. Meghna Malkan, Wealth Mindset Coach and author Johnson right now with her sense. Meghna, good having you. Thanks so much for joining in. What's the risk reward, Meghna, in the market currently for somebody who is wanting to initiate fresh trades, either on the long side or on the short side as well, after we having corrected nearly 750 points?
Hi Neeraj, very good afternoon. Thank you very much for having me over. I believe both Nifty, Bank Nifty, broader indices seem to be on a retracement zone. So for someone who's already in, let's talk about that scenario, I think we should work with very strict stop loss on the support zones. And the support that I see, Nifty could correct up to around 24,400. That's the level I see on Nifty. And when it comes to Bank Nifty, it looks like around 55,000 rough on Bank Nifty. For someone who is sitting on the sidelines wondering whether, to get up some position into the market, I think it's a wait and watch situation. Wait for the current retracement to take hold at these support zones and then think of entry.
Meghna, hi, Tamanna here, and good to speak with you as well. Just trying to understand on Kotak Mahindra Bank, after the kind of hit that we have seen, some might say outsized, do you see an opportunity here for accumulation?
Hi Tamanna. Not as of now, I would say on Kotak Bank. A lot of technical reasons for this. First of all, if you pull up the weekly chart, after a very long time, it seems to have reached the 20-period moving average. It's trading below the 20-period moving average right now. The momentum is extremely weak. I mean, the candle is not yet over. We are just beginning the week. But this itself says the bears have taken control right at the beginning of the week. So I would say this is a breach of quite a medium-term support, I would say. So I would rather wait for it to see where it is going rather than take a call. A very important level of support that I'd be looking at is around 1900 level, honestly. Below that, it would turn even the monthly charts into a very bearish zone. So I would stay out of Kotak right now.
Yeah, so 1900 is where you start seeing some comfort. If I were to ask you this question on TCS, the other sort of stock under pressure, but not as much as we started out with, TCS and maybe add a Wipro as well.
Yeah, TCS, I think it's a knee-jerk reaction because of results. But overall, even the higher time frame chart seems to show intense weakness. So TCS is something, again, I would, in fact, TCS is something which, if it comes to the moving average on the weekly chart, I would look for shorting opportunities because the momentum has gone inherently weak. So that is something I would look at. And if I open the Wipro chart, technically, Wipro seems to be on the same zone. It's just that hanging around a very important support zone on moving average on the monthly chart. But I wouldn't think it's going to take a lot of pressure from the bears to put it down. So this one I would stay away from as well.
Okay. And Meghna, in light of such a view on the markets, what are the ideas for this afternoon?
So I like the two sectors that seem to be pretty confident right now is the pharma sector and the cement sector. Pharma by default, when markets under retracement, pharma seems to be doing well. PBL pharma is something that I really like in the pharma sector. Technically, it's good. Momentum on the weekly basis is good, which gives me good confidence. You can buy with a stop of around 200 for targets of 220, 235 on the higher side. Second one that I like is from the cement sector. That one is Ramco Cement. That seems to be good. Monthly charts do look good. And what I love about Ramco is the volumes that are building up with bullish candle patterns. So Ramco is again a good buy with a stop of 1145 for a higher target of 1230.
Well, the risk reward on Piramal, viewers, is extremely favorable because Meghna is keeping a very tight stop loss and the target's some distance away. So keep an eye out for that one. And I wonder if it's got to do with the fact that the CDMO companies are clocking in good numbers and the reactions showing on those stocks. Siddharth Khemka joins in here. He's the head of research wealth management at Motilal Oswal. And Siddharth, I'm tempted to ask this to you, right? Because of the fact that Piramal is coming in the list of buying on a day like this. Laurus is trading at life highs after the results that have come out. What's happening with these CDMO companies? Are you constructive here or have they done up a bit too much too soon?
So good afternoon, Neeraj. Yes, glad to be on the show. I think within the pharma space, which is one sector which has shown a lot of resilience in the current volatile market, there are two segments which clearly stands out. I think A is the CDMO players where we are seeing very strong earnings growth delivery, and the other is the healthcare, or you can say the hospitals, which are again showing strong growth in terms of numbers. So we are definitely very constructive and positive on the CDMO companies, including the likes of within the large caps. If you say you have DVs, but in the mid cap space, Laurus, we still have a positive view. We believe that the strong earnings growth trajectory could continue in FY26, FY27 as well going forward. We believe that earnings growth could be in excess of 60%. Hence, if you see, there are products, so the new commissioning of Vizag plant, enabling of higher margin of opportunities. So those kind of developments, plus the robust execution in the CDMO, I think, which is still 31% of the overall sales for Laurus, where you have strong growth, that is contributing to the overall momentum. So we continue to remain positive on Laurus. We have a target of 970 out there, but I think with the earnings growth continuing to be in the excess of 50-60%, there could be even further upside to a name like Laurus.
What about a Wockhardt, Siddharth?
So Tamanna, Wockhardt, we don't have coverage, but again, good strong numbers. We are seeing improvement on a quarterly last 2-3 quarters, but unfortunately don't have it under active coverage.
Nevertheless, I mean, Wockhardt today come off its highs, but exciting news in terms of Zenic really coming in as a blockbuster miracle kind of a drug. You know, let's get a technical view also on Wockhardt right now. Malika with us for more on that. What do you make of Wockhardt? Okay, we'll try and get that line sorted. Let me go across to Puneet right now for stock of the day. We're talking about Cartrade right now, and that stock is completely surging. What's working for it, Puneet?
Well, the company did come out with its quarterly earnings today, and it's again been a quarter which has exceeded expectations, as well as really strong commentary for its OLX vertical. So let's first look at the key numbers. Revenue was up 22% in this particular quarter. That has of course been led by strong EBITDA as well as profit. So EBITDA is up 98% in quarter one. Profits as a subsequent is up 92% as well. The other key aspect is all three verticals have been firing really strongly, both on revenue as well as on profits. If we can load up the table really quickly on that, the revenue growth for the consumer business is up 32% in this particular quarter. Remarketing is also up 36%, while OLX, still finding its feet after its acquisition by Cartrade, is up 12% in terms of revenue. But when you look at the profits, and this is where the real story is, 70 to almost 258% of profit growth for all the three key verticals, and the subsequent turnaround in OLX is what the company had mentioned in the last couple of conference calls as well. Let's also look at some key highlights from what they mentioned in the OLX business in this particular quarter. They've launched the Elite Buyer program, something that they promised in the last quarter. They're also looking to have multiple new launches in OLX in this year. So they're having 3 more by October of this fiscal year. And this will enhance the company's total addressable market, not just for US products, but across that category as well. The other positive for OLX was, which led to the 71% growth in terms of profits, was costs which have started to subside now. So ESOP costs, which were there in FY25, have disappeared, because these are ones which were vested in 2020 and 2021. The OLX's market share has also inched up to 37%, and that's for used products specifically. So that's actually a key positive, because of all the used car market, 37% of market share is now resting with just one company that's also listed. So that's one key benefit for Cartrade overall. The other aspect that they mentioned is slowdown in the car industry. Now that's actually hasn't hampered the classified industry. So they've actually had 7% growth in this time, despite a 1% drop in car volumes. And finally, in terms of new growth areas, they're looking to go into the real estate space. That's the second largest category now created after auto. They've already had some product establishment, but essentially it's the new searches within the auto as well as real estate that's benefiting the company. So overall, really strong numbers. Another quarter where they've beaten estimates, and going forward with new product launches in the OLX space, that should help the company going forward in terms of growth aspirations for Cartrade as well.
a jump in for Cartrade, and actually it's quite heartening to see platform companies start talking about profitability in better numbers as well. Thank you for that, Puneet. Meghna, if you can hear me, just come in on Cartrade, and earlier I asked you about Wockhardt as well.
So Cartrade, definitely, it's got a very big monthly breakout, and of course the volumes have been above average in this month's bullish candle. It's clearly a breakout, it's a little breakout trade. Risk reward ratio as of now, it's really far to have that kind of risk. I would believe mid candle range, which is around 1940 to 1960 is the zone where you could be looking for buying opportunities. So that is one on Cartrade. And when you talk about Wockhardt, yes, similar to all the pharma companies, even Wockhardt is on the monthly chart, it does look good. But if I have to compare a Wockhardt with Piramal or something like the one that we just discussed on the pharma side, I think the other ones are way bullish than Wockhardt. There seems to be a little bit of indecision when it comes to monthly chart. The candle patterns somehow seem to have a bearish shadows, that's called the supply shadows. The volumes are getting a little dry at the top. So that is something I would not choose if I have the other pharma sectors, stocks to choose from.
Okay, so what would be, then let me press on in that. If you not choose Wockhardt, what would be your top pharma pick right now?
That's what yeah.
Good.
Well, because she just gave it today as a trade.
Okay. So Piramal Pharma, is that it? The start and end of the
Piramal
pharma list?
yes. PPL Pharma is a much better than Wockhardt. Yes.
Okay, Piramal Pharma it is as one of the key picks over there. But, I just want to get Siddharth Khemka in on the kind of, I would say, negativity around banks and NPAs right now. We're going to wait to hear from IndusInd today, and that's going to be the big one, Siddharth, considering a lot of issues. With IndusInd, it's a whole Pandora's box. So I don't want to be glued to that, those numbers and any commentary if there is from the management. But in terms of what you've seen with Kotak Mahindra Bank, let me expand it to BFSI space, SBI cards, Bank of Baroda was relatively okay. How are you looking at that space right now? Do you see it with a bit of concern?
So yeah, Taman, I think some of the banks, larger ones, have already announced the numbers. I think SBI is the one which is still left. But clearly the indication is that there is some stress definitely in the industry in terms of asset quality. We heard that from Bajaj Finance. We also heard that from Shriram Finance. So some of the NBFCs, I think they are clearly facing that struggle. What looks decent is that if you look at the advances growth as well as the deposits growth, I think what we were expecting is at about 8-9% of advances growth in the system, and that is a decent number to look at in this environment. Deposit growth, some of the larger ones have managed to do that. ICICI Bank clearly outperformed in terms of advances and deposits growth. HDFC has been focusing on that deposits growth in the last 2 quarters, advances mid-single digit, but definitely a lot of focus on deposits growth. So these are the two ones which we feel in the current environment they have managed to report steady asset quality control and healthy business growth. Apart from that, Axis, I think pretty weak numbers. Kotak also, the elevated provisions led to some decline in the profitability. I think advances growth was decent. So that is something we believe that over the next few quarters, Kotak might see some improvement. But for now, the focus clearly within banks is with ICICI, which has consistently reporting outperforming numbers. And the second one is HDFC, where we are seeing the efforts and focus to drive deposits growth to bring down the costs of funds. That is really working out. So within banks, remain very selective, and the larger ones prefer HDFC Bank and ICICI Bank.
Okay. Now, numbers were flashing on your screen. Adani Green, decent numbers. I think the revenues are up 60%. EBITDA numbers look strong too, and as a result of which that stock too has moved up. Net profit up 60%. In fact, revenues up 36. Excuse me, but the net profit is up 60%, and the stock revved up a little bit in trade. Watch out, margins came off a little, but with these companies which are trading at such high margins, usually 4 or 5% dip here or there gets taken in its stride. I think the revenue growth numbers is something that would have maybe pleased the street a little bit. Wonder if you look at some of these green energy companies, Siddharth, fundamentally, Adani Green, and if not Adani Green, any other in this space?
Yeah, I think Adani Green, we don't have coverage. Suzlon is something that we have been covering quite recently. I think overall this green energy space looks interesting. There is a lot of focus from the government, a lot of order inflows has happened. And if you look from a global perspective, what has changed since Trump has taken over is that within the overall renewable energy space, solar, which was a key export focused products, that kind of struggled with the sentiments changing, with US saying that they are looking more at the traditional fossil fuels and not at the renewable energy. I think some of these domestic focused companies especially on the wind turbines, wind energy side, that continues to do well. Even we saw the earnings from the likes of Wari and Premier coming out pretty strong. So I think the overall renewable energy theme looks decent. And while we don't have much coverage there, Suzlon is the only one where we have a coverage. We see strong earnings growth there, and hence we remain positive on this entire space.
Okay, stay on with us. Just let's take a look at some of the buzzers at this point that are buzzing on for various reasons, and among them earnings. Well, by buzzing, I mean either moving up or down or showing massive movement, because Zentek, GMDC and SAIL, among others, on that list. Yes, Vansh?
Right, so quite a few disappointing numbers today. So let me start off with Zentek. Now the company has an order book of around 750 odd crores, and the management believes this to be a temporary adjustment phase, and the company targets a cumulative revenue of about 6,000 odd crores in the next 3 years. If we talk about the results, the revenue was down 38%, EBITDA was down 42%, and the margins were at 40.9% versus 43.7%, and the net profit was down 37%. So clearly a disappointing numbers on all parameters. Second on the list is SAIL. Now the company has missed the estimates. There has been a significant decline in the net profit, and it has been dragged by the increase in the stock trade expenses. If we talk about the numbers of the company, the revenue has been down 11%, EBITDA is down 20%, margins have shrunk to 10.7% versus 11.9%, and the net profit is down 40%. Also, Morgan Stanley has came up with a note on SAIL. The brokerage expects the realizations were higher than the expected, and the raw material cost and other OPEX costs were also higher than the expected. Third on the list is GMDC. Now stock is already down 5% in trade. They have also missed their numbers. There has been a slight cut in the margins. The profit has been declined by the revenue, and there has been a decline in the lignite sales volume on a sequential basis. If we talk about the numbers for the company, the revenue was down 7%, EBITDA was down 12%, and the margins were at 23% versus 24.6%, and the net profit was down 27%. So these are some of the buzzers that are reacting on the negative earnings in trade today.
Okay, well, that's a rare earth play, but come off very not really very strongly. I mean, Kotak Bank is 7%, so all the others falling about 3-4% is not really a very strong downtick, but a downtick nevertheless. Okay, moving on to what is arguable. I mean, actually, just wondering, Meghna, do you have a view on maybe a stock like GMDC, which is down about 4% today? It's been touted as one of the key rare earth plays in India, right? So the long-term charts may look good. What about the short-term?
Well, I would start with medium term first. The medium term doesn't look bad actually, because if you see the recent trend right from 2024, it's managed to move over the moving average. It's managed to touch the upper band, the volatility band is called, and that is an indication that the medium term trends have turned. Now, if that being in the positive zone or in the side of the bulls, I think daily or every dip is an opportunity to buy. Moving average supports are usually considered to be good supports, but considering the strong reaction that the stock seems to be giving, I'd rather wait for a stronger retracement to around 375 levels. That should be a good zone for me to have taken a support there. And if I do get bullish candle patterns at that zone on the daily chart, that would be a good indication to get in on the long side.
You know, since you talked about rare earth, the Finance Ministry's monthly outlook is here, and there it has a mention on rare earth as well. It says, according to the Finance Ministry's latest monthly report, India has its task cut out is what it says. Amidst momentous shifts in global supply chains in the area of semiconductor chips, rare earths and magnets, as the world restructures its sourcing of critical technologies and raw materials, India's ability to position itself in these strategic sectors will be crucial to sustaining long-term economic growth and resilience. Just in terms of hint of how serious the government is going to get on rare earth, that's an important one. It'll take some time for it to really fructify, but definitely one space to watch.
Most certainly. And like we said, the short-term blips notwithstanding, the long-term trajectory, India would certainly want to be, as would any country, not want to be too dependent on any other external nation for this. Okay, time now for the bull and bear segment, and that too is something to watch out for today. Well, little surprise, it would be one of the top contenders for the bull versus bear space, and that's Laurus Labs, because it's posted third consecutive earnings beat this quarter. But do valuations become a concern? Are there other concerns? Varsha joins in to present a bull and bear case on this one. Varsha.
Well, thank you so much for that. So as you rightly said, third consecutive earnings beat, which is led by CDMO. Now Laurus Labs is finally, on track. Investors were expecting, investors were waiting, for Laurus Labs to set a good set of numbers, and finally it's the third quarter where they've beaten the estimates, and this is led by CDMO, which has grew more than 100%. And over the medium term, they are expecting CDMO to contribute almost 50% to the overall revenue from 33% currently. That's huge. Now, this coupled with overall revenue growth of 31% and a massive 13x of jump in profit signifies successful strategic diversification into high growth and high margin areas. But API business, ARV business, if you see, saw a decline. ARV business was down quarter on quarter, 19%. So this is one of the key highlights when it comes to concerns. And overall generics, if you see, still dominate, contribute 67% to the overall revenue, and volatility or weakness here can significantly impact overall performance. But they've achieved substantial EBITDA margin expansion to 24% from 14%, and this expansion in margins plus management's guidance when it comes to, they have revised their guidance upwards when it comes to gross margin significantly, determines operational efficiencies, product mix, better product mix, and benefit of operating leverage that is being playing out when it comes to Laurus Lab. But their bio CDMO, if you see, have experienced 33% degrowth due to customer specific issues and pricing challenges that the company has seen. So one of the disadvantages that the company has. But also Andhra Pradesh government, so this is today's news and also one of the reasons why stock is buzzing apart from earnings. Andhra Pradesh government have allotted 531 acres for establishment of Laurus Pharma zone. But as Neeraj was highlighting the valuation concern, the stock is trading at a PE of 95, leaves no margin for error, I would say, and this means any slight miss in future performance could lead a significant stock correction. And that's the reason, if you see, though DAM Capital has given a buy rating, but a few of the brokerages have pointed out concern, like despite the strong Q1 results, some leading brokerages like Goldman Sachs have rated with a sell rating, and even Jefferies has also remained cautious when it comes to Laurus Lab, considering the valuation picture that the company has seen. So overall, good set of numbers, but yes, if any slight miss when it comes to numbers, we may see de-rating in the stock.
Okay. Meghna, thank you so much for speaking with us today. Siddharth Khemka, of course, continues with us. Laurus Labs in focus. We spoke briefly about Laurus Labs and Wockhardt as well. Siddharth, is pharmaceuticals and that space something that you're looking at very, very clearly right now with CDMO players on the top of the line?
So definitely, Taman, I think there is one overhang that continues is how the US tariff that could come on the entire pharma space. But I think again, coming back to the pharma, I think that is one sector which is most resilient in the current volatile environment on back of the healthy earnings growth that they are reporting. So CDMO continues to report strong numbers. We are also seeing strong numbers from some of the biologic companies, including the like of Biocon, where we are expecting steady earnings growth over the next 2 years. So yes, some of these stocks have moved up, even Laurus after the sharp up move. I think fresh entry should be taken on any dips or accumulate at lower levels, as the risk reward may not be that favorable. But on back of that strong earnings growth that continues, we believe that pharma, especially some of the CDMO players, the biologics companies, that should be in focus for investors.
Okay, stay on with us, Siddharth. We'll take a very short break. We'll come right back with what your closing strategy should be. Also, a very heated debate going on in Parliament right now with the Defence Minister answering on Operation Sindoor. We're coming back with all of that after this break.
हेलो, बोलिए मैडम। डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसा हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए ये तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
हेलो, बोलिए मैडम। डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसा हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए ये तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, Real-time stock picks.
Do I buy Ola?
Should I
or
hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live. Ask, decide and
Welcome back. You're watching India Market Close and some so-so numbers coming in for Bharat Electronics. Remember, defense pack has been under pressure. Bharat Electronics actually on the face of it doesn't look half bad because your margin number is good. Net profit at 969 crores, a tad above estimates. That is NDTV Profit estimates. Revenues are below estimate, 4,440 crores. Margin number shows a bit of an improvement there. EBITDA at 1,238 crores. So a bit of a climb up on the stock as it's come in, but margins have come in at 27.9%. So that's BEL for you. The other space that we're talking about in the big story that we're really tracking through the day is TCS's move to cut 2% of its workforce. That's close to 12,000 people. The stock has taken a bit of a beating. So has the entire IT pack, which could be for more reasons than just this. But it's a story which is important to understand in terms of, is this a tectonic shift that we're seeing? Is this just the start of IT cuts that we could see? CP Gurnani joining us for more on that. He's of course a veteran of the space. Mr. Gurnani, thank you so much for speaking with us here at NDTV Profit. And you know, since the morning, a lot of speculation on whether this is AI driven, whether this is just profitability, whether this is trade, tariff, global economics playing out. What do you make of it?
Easy answer is all of above. You know, because we all know geopolitical environment. We all understand that AI has now reached a maturity cycle, and we are looking at deployment of AI now in enterprise also. And number third is clearly every company goes through a periodic optimization cycle, a periodic appraisal cycle. So my belief is that it is all of above. At this stage, I'm quite optimistic about the future. The reason I'm optimistic is because overall, organizations do need to adopt to technology. And technology means we will be focusing a lot more on applications, lot more on productivity, lot more on use cases. So while the structure of the deals will change, the business models will change, but I think companies like Tech Mahindra or TCS will remain in demand. And frankly, when I did my startup Ionos, it was clearly to look at more vertical focus, more deployment. That's why AI on OS, more vertical focused and more AI focused. So I think industry has gone through many tech cycles, and they will go through this also, and they will come out smarter and better.
No, the industry will definitely come out smarter and better, Mr. Gurnani. The concern also is on what is going to happen to the people who are working in that industry. Since you are so ingrained in how AI can streamline operations, the picture after AI, and we're already in it, frankly, does it lead to a much smaller number of employees in any scenario?
You know, we have all embraced technology for a reasonably long time. So it is not that AI is new. We do believe that new jobs will also get created. And for those new jobs to be created means I need to become an impact player. To become an impact player, I need to make sure that I am more relevant for the future. So as long as I continue to hit the refresh cycle, I continue to, do some of the courses on my own, I think I will remain relevant. And if I am relevant, I am an important player in the company.
Mr. Gurani, Neeraj here, good afternoon. If IT companies go about and take some of these cuts but become efficient by a use of AI, I mean, my question is over a 12 to 18 to 24 month period, could this actually be constructive? Efficiency, maybe better margins, lower bench strength, but maybe equal or higher revenues. Could all of these be possibilities?
I think all of us are embracing new business models, which effectively means outcome-based pricing, number one. Number two, more products and platforms. And number three is, do most risk-reward pricing. So yes, it does mean that if we do it well, if we execute well, then as a strategy, this is a beautiful strategy. That means we will get compensated for business results, and that really means is that we will be able to get higher margins. Now, number two, does it really, translate always in productivity efficiency? I think more important is that how do I, take my assets and convert them into reuse? Because a lot of productivity efficiency really depends on if I'm able to run it like a utility and if I'm able to run it efficiently. So I remain, as I said, not only optimistic, but I think I'm bullish about the industry because most of us have started adopting itself. Like, for example, during my tenure at Tech Mahindra, we created a new product, the company called Comviva. Comviva is all about, in telecom, being able to give platforms, which I know is doing very well for Tech Mahindra, but we anticipated and hence we innovated. And I genuinely believe that you would find similar nuggets in every organization. Right. Time has come to accelerate on these product
Will others
business.
also cut cost heads and cut employee strength after TCS, in your view? Do you think it's coming?
I cannot speak on any other company's behalf, but yes, there is a potential for better upskilling. There is a potential for more, relearning, because when I look at the open job positions of very many companies around the world, I do realize that data scientists, AI engineers, prompt engineers are still in a big demand, and it is for us to now reorient ourselves and become better. There's no point in becoming a testing engineer today. A testing engineer, as we all know, that job could get automated.
No, fair enough. Thank you so much, Mr. Gurnani. Always a pleasure to speak with you. Welcoming now on the show Akshay P. Bhagwat of JM Financial and Sameer Dalal of Natvarlal and Sons. Let's get a quick, fresh perspective, just 15 minutes odd before markets are closing for the day and what has been truly a painful day. Akshay, first, your take on the charts.
Good afternoon. So it's the third, fourth day of consecutive selling, and even the data numbers from the FIA index futures are supporting the sell side. We have broken an intraday short-term support of 24,800 that puts the Nifty index on a weak footing for the short term, and that opens up possibly for downside targets till around 24,500 to 24,550 zone. So yes, some more pain to go. Probably there will be some buying intent once you reach the support zone of 24,500 to 550 zone. So I would say let's wait for that dip before you get into fresh trades, on at least on the index buying side.
Are you buying any stocks, Akshay, or selling any stocks on the short side? Anything?
still comfortable on the buy side of trade. Selectively, we are looking at pharma names because a lot of momentum right now is chasing the pharma sector. And pharma, if I were to name a particular stock, it is Glenmark Pharma, which I believe has yet not caught onto the momentum band, considering the fact that majority of the pharma names already have moved by around 3-4% in the recent last 4 to 5 trading sessions. So if you look at the chart of Glenmark, there was a very strong gap up opening a few trading sessions back. It is consolidating, but the broader technical price setup makes me believe that 2300 and 2350 are the short-term trading targets in the making. So you can buy Glenmark Pharma with a stop loss below 2050. And second trade would be in the private banking space, which is ICICI Bank. This stock has seen a range breakout after a positive set of numbers came in. That was 4 or 5 trading sessions back. This breakout was seen at levels of 1460. So a very strong technical setup for ICICI Bank. And my belief is that 1520 and 1540 would be the two targets in the making on the short term. So I would be buying ICICI with a stop loss at 1445.
Okay. Samir Dalal also joining us from Natwarlal and Sons. Samir, very good afternoon to you. First, let's just start with the market view because market mood seems very somber. What, in your view, is the prime concern over here? Is it the kind of corporate results that we're seeing? Is it a lack of a trade deal? Is it IT and banking both not being able to hold up? What is it?
So I think it is the trade deal plus the poor results that have come in. Surprise negative results from Kotak Mahindra Bank, which kind of put a bit of worry. A couple of the other private sector banks' results have been a bit disappointing. That kind of has put a lot of worries that going forward, given the fact that the NPAs are rising in the microfinance, is that going to be something that creates a problem going forward? And then trade deal, imagine countries all over are signing them. We haven't been able to starting 1st of August. If our tariffs move up, businesses that have taken orders are either, if they've not been able to ship them off in time, are going to start facing problems when it comes to their payments, and or future orders become questionable. So that affects the future growth as well. So it's a whole combination of things. Valuations were not cheap in any which way. What you also mentioned is IT is correcting, and that was simply, I can't argue what Mr. Gurnani was saying because he's an expert of the industry. But I still believe that growth of anywhere between 3 to 5% on the top line and 7% to 8% on the bottom line does not warrant valuation multiples where they're trading. So, it's the combination of everything that's leading to this correction. And then lastly, what you are seeing is, from over the last few days, you've seen FIs continually pulling some money out of the market. There's been some news flows that emerging market, especially India dedicated funds, are seeing an outflow. So that too is adding on to the pressure points. And then you have such a huge lineup of IPOs. So liquidity is going to get sucked out even more. So, it's like a whole bunch of things hitting at together. And that is why we are seeing a correction.
Okay. Well, and a serious corrective move into select pockets, particularly defense and real estate in the session today. So bear that in mind. At the backdrop, of course, India's infrastructure story gains momentum. Adani Ports is emerging as a key player in that transformation because Cantor Fitzgerald believes so, and they've initiated coverage on Adani Ports with an overweight rating. Mahima Johnson will tell us more about that. Mahima.
Right, so as you rightly mentioned, Cantor Fitzgerald has initiated overweight with a target price of 1780 for Adani Ports, which is almost a 28% upside from its current market price. Now, the key drivers behind the rating includes forecast of mid-teens growth in revenue, EBITDA, as well as cash flow by 2029. They're saying that the target price is based on valuation of 16 times forward 27 estimates EV to EBITDA and a DCF of cash flow through FY36. They expect potential special dividend by 2027, and this will be on the back of strong free cash flow as well as low net leverage. Revenue, EBITDA and operating cash flow have grown at a 20% CAGR over the past 5 years is something that they're liking. Business outlook, they're saying that company is well positioned to benefit benefit from India's underdeveloped trade infrastructure and aims to double port capacity by 1 billion million metric ton by 2030, supported by government policies. Logistics volumes expected to grow by 5 times by FY29 is something that they're penciling in. And lastly, marine services targeted to triple revenues by 2027. FY 2027 is what they're saying. So this is the overall view as to what makes them bullish on Adani Ports.
Okay, but well, that's not all, right? Because we are also awaiting some key results. Mahima, and Asian Paints is that big consumer company in focus.
Right. So basically, it's set to host its earnings tomorrow, and it could come anywhere, any time in the market hours. A few expectations where it's going to be yet another disappointing quarter for them because demand has not picked up, and that's something that's going to hurt overall its earnings. Revenue is expected to be flat at the 8,988 odd crores, and revenue also may see a fall of around 2% to 1657 crores. Margins may fall slightly to that 18.4% mark, but still within the guided range of around 18 to 20 odd percent. Net profit may see a fall of around 5 odd percent. So muted set of numbers overall. In terms of what to expect, well, urban demand to remain under pressure, but the commentary is going to be crucial because we'll have to see whether they continue to say that second half will be better for painting industry or not. Secondly, margins will be slightly under pressure because of inflation. Price hikes will, however, try to offset some of this inflationary pressure. Rising competition from peers, of course, that's been the story for the painting sector, and commentary on that will also be important, especially in the tier 1 areas where Asian Paints has larger dominance. It's expected to underperform peers because of its larger presence in tier 1 and urban demand not picking up. Key monitorables, the key monitorable, something that I'll be watching out for as to how they'll deploy the money that they've received from the stake sale in AkzoNobel, and of course demand outlook and the kind of competition and price hike impact. So this is the overall view of what you can expect from Asian Paints earnings.
So Asian Paints earnings, IndusInd Bank earnings also is something that we need to watch out for. Akshay, on charts, both Asian Paints and IndusInd, anything that you're penciling in? Is there a bet here?
Yeah, so Asian Paints, it's a neutral setup and there is no trade evident here. Even if I were to look at the option setup, that's for the monthly 31st July, 2300 support and 2450 resistance is what comes to my knowledge. So most likely the way the setup looks in the F&O segment, chances are that it will be more of a muted reaction post the results. And technically also there is no major trade evident going by the current setup. As far as IndusInd Bank goes, I think a similar setup here, upside a bit looks capped here. There is strong resistance which has been building up at the levels of 850, where selling or long liquidation is pretty much apparent in the recent little bit of recovery which we noted in the stock. So in all likelihood, the chances of the stock moving till 700 or 720 on the downside looks likely. So here again, I would advise to wait and watch before committing any buy positions. At least 850 is the first caveat. It should cross, then we will review it for buying, or we will review it for buying at the support base at 700.
What about your BTST ideas, Akshay?
So right now, see, the market breadth is pretty weak, as I understand, and I think the ICICI Bank buy call, which I mentioned on air a few minutes back, that is one of the strongest setup. So in case one is keen on just a BTST trade where you want to book out in the first hour of trade, then with a small stop loss of 1477, you can commit a BTST in ICICI Bank. 1488 is the current market price, and if you get a little bit of support from the Bank Nifty, I think 1520, 1540 would be the short-term targets you can look forward to.
Okay. Well, Samir, Kotak Bank has suffered so much today, and the question is, and Bajaj Finance did that on Friday too. Some of these marquee blue chip financials, would you be a buyer into any of those if they correct further after the correction that we've already seen in them?
Yeah, so Kotak Bank, actually, I think I would be a buyer. Bajaj Finance, I still feel valuations are a bit on the rich side. Look, Bajaj Finance has now got scale, right? So now they're not growing at 30-35% anymore. Plus, when we sat for the call and we spoke to the management and we did all of that, we realized that there are certain pockets for them which they are going to be very cautious on, which were the previous growth drivers, right? So when some of your growth drivers of your past are now going to become problem points, or lead to some amount of increase in NPAs and slowdown in growth, that sends a picture where your overall growth is not going to be so good. So when you're going to be growing in the similar line of some of the larger banks and still trading at maybe 1.5x, close to 2x some of the valuation multiples that the private banks are trading at, it sends out, I mean, it's something that I would choose to avoid for the time being. Kotak Mahindra Bank, yes, there's been a one-off. They've also been guiding that this is, a temporary thing, and they will probably recoup some of the, provisions that they've had to take in this quarter, and also maybe, see provisions being lower going forward. So if Kotak corrects closer to 1750, 1800 levels, I think it makes a good buying opportunity.
Okay. What else? Real estate has looked very, very wobbly. Samir, are you a buyer into any of the real estate names at all? Is the question that very quickly, Samir, if you can answer in under 30 seconds, please.
Yeah, so, we do like real estate, and Keystone Developers is something that we've discussed on your channel as well. Godrej Properties, if it comes closer to 2000, it looks attractive. Real estate is something that will do well longer term. So I think you can buy, but at good valuations or better valuations.
Okay. Okay, well, something that might be a concern but shouldn't be, right? Because sources have told NDTV Profit the government is set to rectify the drafting errors in the newly proposed income tax bill. My colleague Shrimi, who broke the story, Johnson with more. Shrimi.
Well, it looked like some big relief on the cards for both corporates and non-corporates entities, as government is set to make some key correction in the proposed income tax bill in line with the select parliamentary panel's suggestion. Now, sources tells us that there are certain drafting errors which could be rectified in the proposed bill, and that will be reflected in the final bill. Now, the provisions and sections in the draft bill, and some of them are actually creating quite a stir among investors as well as taxpayers on the tax treatment. And one among those is with respect to the long-term capital gains on the limited liability partnership and similar sort of partnership funds. So what happened here is that the draft bill actually proposes to expand the scope of, alternative minimum tax for LLPs. Remember, in the existing Income Tax Act, the alternative minimum tax applies to only those LLPs if they claim certain deduction on it. However, that particular rule has been removed in the draft bill, which is making the whole, LLPs and the family offices jittery, and now they are seeking explanation as it increases the tax rate to 18.5% from existing 12.5%. Similarly, on the corporates claiming deduction on the dividend has been also removed. Sources tells us that it was omitted inadvertently in the draft bill, and that will also something will be restored in the final set. Certain provision with respect to nil TDS, refunds are also some provision which are kind of creating confusion and could be restored in the final sort of bill. Now, sources said that, the government has accepted all most of the suggestion of the parliamentary panel, which is around 285 suggestion, mostly directed towards the rectification in the draft bill. And they are very clear on the fact that there is no policy change in the draft bill, which, with respect to any tax rate change, etc. And in fact, the bill is listed for the passage in the ongoing monsoon session. However, given the kind of tweaks and changes which is required in the draft bill based on the suggestion, it could take some time. And that is why the passage of the bill could differ for the next parliamentary session. However, no decision has been taken so far. So for now, the bill is listed. However, we need to see whether it will be moved for passage in the ongoing session or not.
Okay, thank you for that, Shamina. That's an important clarification, Samir, because I think there is some stress there that long-term capital gains tax, if it comes in for LLPs effectively at 18.5%, that means for the Janta, it's not far behind. That's, I think, at the core of the concern. Just wondering what you make of it, Samir. Is that just, sort of a bad overall mood on the market, some cautiousness there, and then this one news adding to fuel to the fire?
So I don't think the markets are correcting because only of this news, because if that is the case, whether you have to pay 12.5 or 18.5, that is not going to change. So I don't think that is what it is. Of course, a negative sentiment wise, but is that the reason the market's correcting? I don't think that's the reason the market's correcting.
Okay, just in terms of last calls, we are a minute away, and just quickly, last calls, what is that one stock that you would look at for tomorrow's trade, Samir?
So we don't do intraday trading or, buy today, sell tomorrow, any of that. We do investments, and I still think that market has a lot of opportunities for investment when it comes to the entire consumption basket, which we've discussed in the past. So the QSR space, if you talk about the consumption, that's Trent, you talk about Bata, you talk about Metro Shoes, you talk about Vedant Fashions. So all of that we think is a great long-term buy opportunity, and that's something we continue to recommend positively.
Okay, fair enough. Thank you so much, Akshay and Samir, for joining in just as we close out the markets, and it's looking like quite a bit of a somber day. Financials not doing too well, real estate not doing too well, and nor is defense. These are some of the pain points that I can see in the markets today. You're looking at the Nifty closing about 150 points in the red, 24,670, 680. So 24,700 is also breached. We talked about it this morning about how core levels, if they're breached, is going to lead to a further pain point. You're definitely there. Bank Nifty also plummeting towards, I won't say plummeting, but really dragging towards close. Let's pull up Nifty IT. In fact, the sectoral heat map. Let's go through the sectoral heat map very, very quickly before we get to the heat map on the Nifty. Nifty Realty is your top loser today. In part maybe dragged down by a Lodha. We can pull in the internals of the Nifty Realty just for a second. Nifty India Defense looking bad. Nifty Private Banks looking painful. Yeah, there you have Lodha, Godrej Property, DLF, Brigade, all of them in the red. I just wonder if this is a knock-on effect of jobs, because if valuable, high-paying jobs which can really dish out those huge EMIs start getting culled, like what you're seeing with TCS, is that bad news for all of these developers which are building those 4, 5, 6, 7 crore apartments with very few who could afford and buy them? Yeah.
Most certainly. I think that's how we came up to this whole conclusion. I mean, is it real estate names? Is it maybe, I think somebody said not the hiring names, but could the credit card companies and those spends also come under a bit of pressure? I think all of that remains to be seen. More importantly, what it does to sentiment, and would the GDP follow, GDP growth also follow that? Though there's only one sector, remember, but certainly an important one from a white collar job perspective. So has looked wobbly. A lot of stocks on the real estate side have looked weak. A lot of stocks on the pharma side have looked okay, and that's been the yin and yang for the markets today. But with that, it's a wrap on this leg of India market close from Tamanna and me and the team that has put this show together. Thank you so much for tuning in.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है?
मैडम एक बात, खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bahuguna. Now let's get straight into the show. So viewers, Monday blues for markets. Both Nifty and Sensex end the day in red. While Nifty 50 ends below the 25,000 mark, Sensex also closed 570 points lower. Most sectors ended the day in the red, with realty and media sectors leading the decline, dropping by nearly 4% and 3% respectively. So only the FMCG and Pharma sectors showed positive momentum, closing slightly up by 0.3%. TCS also to cut 12,000 jobs amid weak demand and cost pressures. So layoffs target mid and senior managers across divisions. AI not the cause, but wage hikes pushed ahead. So other IT firms also show mixed hiring trends in Q1 of FY26. Investec is bullish on TCS, sticking to a 3,705 rupee target despite headlines. So the 12,000 job cuts, about 2% of its 6 lakh workforce, are seen as routine, driven by a mismatch in the employee skills versus changing market needs. Notably, this move isn't linked to AI or panic cost cutting. While margins also may dip briefly, stronger billability and resource efficiency are expected to follow. Tata Consultancy Services plan to lay off about 12,000 employees from middle and senior levels between April 2025 and March 2026. So sources have told that no concern has been brought to government so far. Sources have also mentioned that private sector terminations are not under government jurisdiction unless there is unfair dismissal or breach of labor laws. Kotak Bank was the big stock in focus over the weekend as Q1 results revealed pressure on the key financials. So provisions surged 33% quarter on quarter and over 100% YOY. So largely driven by weakness in the microfinance book, while operational numbers remain broadly in line, margins compressed and profit growth declined. ROA also slipped below the 2% mark, though operating expenses helped cushion the blow. Tamilnad Mercantile Bank reported a 6% rise in the Q1 of FY26. Net profit also, to 305 crore rupees, driven by a 90% drop in provisions to 8 crore rupees, despite a 12% decline in the operating profit to 412 crore rupees. So net interest income grew 2% to 580 crore rupees, but margins fell to 3.8%. Deposits rose 9%, and advances grew 10.4%.
So the asset quality has improved with gross NPA at 1.22% and net NPA at 0.33%. So the bank aims for 15% advance growth and 10 to 12% deposit growth in FY26, expecting NIM stabilization. Macquarie maintains an outperform rating on Titan with a price target of 4,150 rupees, citing strong brand equity and growth potential in the UAE and Kuwait through the Damas acquisition. So the brokerage likes Titan's focus on premium designs and lab-grown diamonds. However, slower EPS accretion and the exclusion of the Gra franchise, which is 20% of Damas's sale, are seen as drawbacks. Acme Solar has delivered a blockbuster Q1 performance. Revenue surged 65% year-on-year to 511 crore rupees, while EBITDA jumped 68.5% to 458 crore rupees. Net profit skyrocketed to 131 crore rupees from just 1.4 crore rupees last year. So this is driven by scale efficiencies and new capacity. Margins have expanded to a stellar 89.6%, which is nearly 90%. Orient Cement has crushed expectations in Q1. Revenue rose 24.4% year-on-year to 866 crore rupees, while EBITDA nearly doubled to 182.6 crore rupees. Net profit also skyrocketed 459% to 205 crore rupees, and margins expanded to 21.1% from 13.8%. Premier Energies shines in the latest quarter with steady growth and rising efficiency. The company continues to expand its clean energy footprint, powering a brighter future while strengthening its bottom line. So revenue rose almost 10%, while EBITDA surged 53%. Net profit climbed 56% to 308 crore rupees, and the margins have expanded to 30%. J&K Bank posts strong Q1 numbers with a 17% jump in the profit and margins shrink as deposit growth beats the loan growth. So interest income is up, but cost of the funds have risen faster. So asset quality stays steady despite the NPA provisions. Laurus Labs zooms post Q1. Net profit zooms 13 times year-on-year on the CDMO-led growth. Revenue also jumps 31% with sharp rise in the EBITDA margins. Gross margins improve on better business mix, and API weakness partly offsets the gains in the generic FDF. Wockhart's novel antibiotic, Zanuck, grabs the global spotlight after saving a critically ill US liver transplant patient. Now, the patient had pan-drug-resistant infections, unresponsive to all the available treatments. So Zanuck cleared the infection in just 11 days, enabling a successful transplant and chemotherapy resumption. So the drug has completed phase 3 trials and targets a $25 billion global market. Brigade Group launches its new premium residential project, Brigade Avalon, in Bengaluru's Whitefield area. Now, this project spans 4.36 acres and features 206 carefully designed homes with spacious 3.5 and 4 BHK configurations. Brigade Avalon offers a bold architectural identity with private decks, light-filled interiors, and flexible home office spaces to suit modern living. So the development includes a grand clubhouse with premium amenities for all the age groups. GAIL Limited is filing an arbitration claim seeking up to 639.18 crore rupees plus interest against the Focus Energy Limited, iServices Investment Limited, and Newbury Oil Company Limited. Now, the claim have actually, arisen from the non-supply of makeup gas and a shortfall in the supply of gas under 2009 gas sale and purchase agreement. So GAIL has formally submitted its statement of claim to the arbitrator, asserting that it's right to recover damages for these supply failures. Recently, the Delhi High Court has also directed the respondents to secure 158 crore rupees through a bank guarantee or assets to project GAIL's claims during the arbitration. Now, this legal move asserts GAIL's commitment to enforcing contractual obligations and protecting its financial interests amid the dispute. Dr. Reddy's Laboratories has made a significant investment of 565 crore rupees in its Russian arm. So Dr. Reddy's Laboratories LLC Russia, which is acquiring a 45.19% equity stake. Now this infusion has completed on July 25th and is aimed at supporting the working capital requirements of the Russian subsidiary. So DRL Russia has demonstrated strong business performance with a reported turnover of about 2,347 crore rupees for the fiscal year of 2024-25. Now this investment reflects Dr. Reddy's commitment to expanding and strengthening its presence in the Russian pharmaceutical market. Citi maintains a buy rating on Mahindra & Mahindra, raising its target price to 3,810 rupees. The firm highlights strong momentum in both M&M's utility vehicles and the tractor segments. So tractor sales have benefited from a healthy harvest season, while UVs are also performing exceptionally well, firing on all cylinders. M&M's volume growth is notably stronger compared to its peers, reflecting robust demand and solid rural market traction. J&K Bank reports its Q1 performance with key takeaways showing a sequential dip in the margin, faster deposit growth compared to advances, and a decline in the yield coupled with a rise in the cost of funds, while asset quality remains largely stable. So year-on-year, interest income has risen 9% to 3,268 crore rupees. Within the interest expense, the interest expense going up 11% at 1,802 crore rupees, and net interest income also has improved 7% at 1,466 crore rupees, and operating profit grows 13% to 673 crore rupees. Steel Authority of India reports its Q1 results with revenues declining 11.6% at 25,922 crore rupees. Now just missing the estimates of 25,790 crore rupees there. So EBITDA drops 20.5%, matching the expectations, while margins remain stable at 10.7%. However, net profit takes a significant hit, down 40.5% to 745 crore rupees against an estimated of 1,076 crore rupees. Now, this sharp decline is actually mainly due to an increase in the stock in trade as SAIL proactively stocks raw materials. Lodha Developers reports a strong Q1 performance with pre-sales rising 10% year-on-year to 4,450 crore rupees. Collections also grow by 7% year-on-year. The company maintains its full-year guidance, targeting 20% growth in the pre-sales for FY26. During the quarter, Lodha launches new projects worth 8,300 crore rupees, while Q2 launches are limited to a new phase at existing locations. Consolidated revenue also jumps 22.7% to 3,492 crore rupees, and EBITDA increases 30% to 984 crore rupees, with margins expanding to 28% from 26%. So net profit has surged 42% to 675 crore rupees. RPG Life Sciences has reported a challenging Q1 performance with mixed business segments. The domestic formulation business grows 9.5%. The API business takes a hit, declining 22.4%. Overall, the revenue edges up 2.1% to 169 crore rupees. So net profit also sees a marginal increase of 1.8% to 26.3 crore rupees. GMDC reports muted numbers for Q1, with a slight dip in the margins, and profit also impacted by a decline in the revenue quarter-on-quarter. So the sales volume have dropped nearly 9.6%, which is reflecting a softer demand. Year-on-year revenue have also fallen 6.8%, while the EBITDA has decreased 12.6%. Margins have contracted to 23% from 24.6% previously. So net profit takes a sharper hit, declining 27.6% to 164 crore rupees. Overall, GMDC faces top-line pressures and margin compression in a challenging quarter. Cartrade delivered a robust Q1 performance, marked by impressive double-digit growth across the key metrics and strong margin expansion. The company has capitalized on its solid momentum in its remarketing and consumer segments, while the OLX continues to shape into a strategic growth lever, and that also makes it the stock of the day. Adani Green Energy reported a robust Q1 of FY26 with consolidated net profit soaring 60% year-on-year to 713 crore rupees from 446 crore rupees. Revenue jumped 36% to 3,800 crore rupees, which is up from 2,794 crore rupees, driven by a 41% increase in the operational capacity to 15,816 megawatt. So EBITDA has risen 28% to 3,042 crore rupees, though the margins have dipped to 80.1% from 85.1% due to higher expenses. The company has added that 3,135 megawatt in greenfield capacity, including solar and wind projects, reinforcing its leadership in India's renewable energy sector with a 50 gigawatt target by 2030. Zen Technologies reported a 38% drop in Q1 of FY26 net profit to 47.8 crore rupees from 76.8 crore rupees, with revenue also down 37.9% to 158 crore rupees. So EBITDA has fallen nearly 42% to 65 crore rupees, and margins have contracted to 41% despite the dip. The company has maintained a debt-free balance sheet and a 754 crore order book management, which is led by Ashok Alturi. Atluri views this as a temporary adjustment, targeting 6,000 crore rupees of revenue over FY26 to 28. So the acquisition of TISA Aerospace bolsters its UAV capabilities with 150 crore rupees in the new order secured. US President Donald Trump announces a new trade deal with the European Union, calling it a good deal for everybody. So after high-stake talks in Scotland with EU chief, the US imposes a 15% tariff on EU imports. Now in return, the EU pledges $600 billion in investments and $750 billion in energy purchases. Now both the leaders hail the agreement as a breakthrough aiming to end a long-standing transatlantic trade dispute. The $2 trillion US-EU trade deal is turning heads across the global markets, especially in India's auto sector, with car tariffs slashed to 15% from 27.5%. Top Indian players like the Tata Motors, Samvardhana Motherson, Sonar BLW and Bharat Forge are poised to benefit. Now for Tata's JLR unit, exports from the Slovakia now face lower duties, while Bharat Forge and Sonar BLW could actually see improved margins on their hefty US-bound exports. Now this tariff reset configures supply chains and offers a competitive edge to Indian firms with transatlantic exposure. Bharti Airtel's data center division, NXTRA, has signed an agreement with Ampin Energy to procure an additional megawatt hours of hybrid solar and wind energy. Now, this renewable power will be sourced from plants connected to the interstate transmission system, and exchange filing says that the deal supports NXTRA's goal to increase the use of sustainable energy in its data centers to reducing its carbon footprint. The Tata Sons board is set to meet ahead of the annual general meeting scheduled for August 14. The AGM agenda includes approval of the company's financial statements and key appointments and reappointments. So Noel Tata is proposed to be appointed as a director and nominee of Tata Trust. Additionally, Mr. Venu Srinivasan, Saurabh Agarwal and Anita George are up for reappointment to the board, with Anita set to continue as an independent director. Amber Group's, through its subsidiary, has signed agreement to acquire about 40.24% of Israel-based Unitronics. Now, this deal is signed for 400 crore rupees. Now, the acquisition is also scheduled to complete within 2 months. Unitronics, which is listed on the Tel Aviv Stock Exchange, supplies industrial automation products such as programmable logic controllers, human-machine interfaces, server drivers, and SaaS solutions. Vietnamese electric vehicle maker VinFast has opened its first showroom in Surat ahead of launching its manufacturing plant in the country. So the company plans to establish 35 dealerships across at least 27 cities in India by the end of the year. To support its expansion, VinFast has formed strategic partnerships with Road Grid, TVS and Global Assure to build a network for charging infrastructure and after-sales services. The Department of Telecommunications has issued a show-cause demand notice to Tata Communications for about 7,800 crore rupees over AGR dues. Tata Communications stated that in an official note that the demand includes amounts related to disallowed deductions under its ISP and NLD licenses, with appeals already pending before the Supreme Court. The company asserts its licenses are separate from those impacted by the Supreme Court's 2019 AGR judgment and says that it's based on legal opinion. It also expects to be able to defend its case. Indian Bank has received board approval to raise 5,000 crore rupees during the current financial year. So according to CEO Binod Kumar, the bank reported a rise in its capital adequacy ratio to 17.8% for the April-June 2025 quarter. The bank does not plan to use QIP or other instruments immediately. So in addition, Indian Bank is set to launch its own UPI-based payment app, IndUPI, so to reduce the operational cost. Now, the bank has also received approval to hire 3,000 employees this year across various levels. Security forces in Srinagar have successfully concluded Operation Mahadev, resulting in the neutralization of 3 terrorists. Among those killed was Suleiman Saha, who is known for his involvement in the recent Pahalgam attack. Officials have confirmed that the 2 slain terrorists were Abu Hamza and Yasir. So all 3 were identified as members of the Pakistan-based terror group Lashkar-e-Taiba. Following the operation, security personnel are conducting thorough checks of the commuters in the vicinity to ensure the safety of the area and maintain vigilance. The Delhi government is set to launch its Logistics and Warehousing Policy 2025, aiming to ease congestion, lower pollution, and improve the trade efficiency. The draft policy proposes creating dedicated logistic hubs, green firefighting corridors, and also deploying technology-driven solutions to the streamlined goods movement. Now, Delhi now handles about 10 lakh tons of freight daily via nearly 1.93 lakh vehicles. So, key measures include relocating warehouses to city outskirts and switching last-mile deliveries to electric and CNG vehicles. Thailand and Cambodia agree to immediate ceasefire for their border conflict. The fighting, which flared up last Thursday after a landmine explosion, has displaced tens of thousands of people on both sides of the border. Over 2 lakh villagers have evacuated their homes, with many now staying in the temporary camps. Now, a shocking act of violence has been reported in the Thai capital in Bangkok. At least 6 people are dead following a shooting incident at the Torkor market. Now, the fatalities include the gunman, who reportedly took his own life. The Emergency Medical Center reports that 4 security guards and 1 woman were also killed in the attack. Now, the market, which is known for its agricultural product and local foods, is now the scene of a major police investigation. A regional passenger train has derailed in southern Germany, resulting in at least 3 deaths. Investigators are looking into the cause of the derailment. Around 100 people were on board the train when 2 carriages went off the tracks. Now, the crash happened after storms passed through the area. Authorities are working to determine if the weather has anything to do with it. Shubman Gill has etched his name in history, becoming the first Asian cricketer to score 700 runs in a test series in England. The Indian captain's gritty 103 in Manchester's 4th test broke Mohammad Yusuf's record of 631 runs. With an unbeaten century, Gill also joined Sunil Gavaskar and Yashasvi Jaiswal as the only Indian to score 700 runs in a test series. With that, viewers, it's a wrap on this edition of Market Express, but please stay tuned and don't go anywhere, as my colleague Malika will take over Profit 360 on the other side of the break.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is
Except Pharma, all other sectoral indices end in the red, with Realty Index plunging 4%, Media Index shedding nearly 3%. In the third cost-cutting move in 3 months by TCS, the IT firm now plans to reduce its workforce by 2% in the financial year FY26. It's an NDTV Profit exclusive. Nestle India bets on both urban and rural segments for growth. Catch the exclusive conversation with Suresh Narayan, Chairman and Managing Director. A blockbuster week for IPO watchers, from main board giants to SME entries. The primary market is about to see a flurry of action, with a total of 14 IPOs hitting the markets. Finance Minister Nirmala Sitharaman says India must navigate global supply chain shifts in semiconductors, rare earths and magnets. Sources tell NDTV Profit the government will address drafting errors in the Income Tax Bill 2025, potentially deferring its passage to the winter session. Suleiman Saha, a Lashkar-e-Taiba terrorist identified as the mastermind of the April 22nd terror attack, gunned down in an encounter near Srinagar this morning. Operation Mahadev also neutralized 2 other terrorists, Abu Hamza and Yasir. Hello and welcome viewers. Good evening. This is Profit 360 on NDTV Profit and I'm your host Malika Mishra. Along the next half an hour, we will be bringing you the latest on markets as well as national and international news. So stay tuned. Let's begin with checking on the markets. The Lal Street saw Monday blues as the benchmarks ended more than 0.5% lower. Nifty IT extended its decline for third consecutive session. All indices except FMCG and the pharma sector closed in the red. Mid and small cap indices underperformed the benchmarks. Let's now go across to my colleague Puneet Javeri for a detailed roundup of the market action.
Well, thank you for that. So it was a day largely bound by pressure across the benchmark as well as the broader markets. The Nifty ended almost 0.6 to 0.7% down in trade today, and it was led by across the board selling pressure. When you look at the mid-cap 150, we also saw selling pressure led by the Nifty Realty. So we saw stocks like Godrej Properties, SBI Cards, amongst others, that were the top losers of the day. We've also seen pressure on the Nifty small cap as well. So hence the benchmark indices largely outperform the broader markets, and it's a trend that we've seen happening across the board now, but still a negative trend to say the least, because ever since we've broken the 25,000 as a support on the Nifty, that selling pressure has been incessant. So when you look at some key sectors as well, the Nifty IT was largely in news. While it was recovered, by the end of the trading session, we saw pressure largely led by what happened with TCS. The company has announced 12,000 job cuts for at least in this year, and that's across middle as well as senior management. We also saw pressure on stocks like Wipro, amongst others. Among other sectors, we also saw that the Nifty Realty was the top sector losers. This was led by DLF as well as Godrej Properties, as mentioned, while other sectors like the Nifty Oil and Gas, Nifty Bank as well as the Nifty Financials were some of the other key sectors which were under pressure today. So overall, it will be a week led by earnings reactions, and we're going to see the auto pack being largely in focus starting Wednesday. Apart from that, some EMS players will also come out with earnings, but the Nifty IT has underperformed over the last 2 weeks, while the Nifty Bank has been led by the large cap bank players. Overall, the market is going into a consolidatory phase, and we will see earnings reaction across the other sectors starting this week now.
Right, Puneet, thank you so much for helping us understand how the markets fare today. Domestic investment flows in India are showing no signs of slowing down, and as long as those flows keep coming, Indian markets will continue to prosper. That's what Nepean Capital's Gautam Trivedi told NDTV Profit. Let's listen in.
Let's look at the numbers this year, right? If that was indeed the case, foreigners year to date have sold $9.6 billion out of India. Now, the India growth story, yes, has slowed down a fair bit, but the fact is the future still remains extremely bright. So you have at one breath a sovereign wealth fund, as you've seen in this morning's papers, talking about making a big investment in a housing finance company. And at the same time, you have pension funds looking at deploying more money. So you've got that. But then if you look at the overall active investment community, which is within the FI side, I think that is really the question that people are asking. Why is it that they are net sellers? And there are a bunch of reasons for that. I think one of the prime reasons, if you look at it, is the fact that the Indian market, again, it's always been expensive, but today it's at the same valuation as the S&P 500. In fact, the S&P 500 is at a bit of a discount to the Nifty 50.
And let's get you an update on some of the earnings. Adani Green's Q1 profit saw a 60% uptick. The company's total revenue from operations rose 36% to 3,800 crore rupees during the quarter from 2,794 crore rupees last year. Let's bring in my colleague Hero for more on this.
Yes, absolutely. A strong set of numbers that have been reported by Adani Green and clearly reflected in the stock price performance as well, because the stock ended at the day's highest levels. If you see in terms of the key highlights, the growth was mainly led by a robust greenfield capacity addition of around 4.9 gigawatts, and that led to a revenue growth of nearly 36% on a year-on-year basis at 3,800 odd crores. The EBITDA saw a growth of around 28%, and that number came in at 3,042 odd crores. The margins came in at 80.1% versus 85.1%, and the net profit grew nearly 60% at 713 odd crores. Now, they've deployed advanced renewable energy technology as well, which actually aided numbers this time around. The plant performance also has been superior, and they've deployed new capacities in resource-rich sites, and this is what has led to this kind of growth. If you compare on a sequential basis as well, the numbers have been absolutely strong. And if you talk about the profits, a good surge of nearly 115% is what you've seen, and the revenues have jumped nearly 24%. In terms of the guidance, what the company has said is that they're pretty much on track to achieve the 2030 target of 50 gigawatt renewable energy capacity. Now, at least 5 gigawatt of hydro pumped storage plus battery storage is what they're looking at, and battery storage will be a key part of their future strategy. Talking about further development, 30 gigawatts of renewable energy plant is what they're developing at Khavda. So strong guidance coming in there, strong performance on the sequential and on a year-on-year basis, and that is what has aided the stock price as well, which ended at the day's highest levels.
Right, Hiral, thanks for that. And Bharat Electronics, viewers, delivers a healthy performance in Q1. The company's net profit rose 22.6% year-on-year to 970 crore rupees, backed by strong operational gains. Revenue was up 4.6% as well at 4,440 crore rupees, and EBITDA saw growth of more than 30% to 1,238 crore rupees, showing better cost control and also efficiency. Margins also see a solid jump, improving to 27.9% from 22.3% a year ago. Now, banking also is another sector under fire on the back of their first quarter performance. Most large banks have reported their numbers, and IndusInd, however, is yet to announce its Q1 performance later today. Let's get in back my colleague Hiral to let us know what is expected out of IndusInd Bank's Q1 earnings.
The stock has been under pressure ahead of the numbers. It's trading near the day's lowest levels as we speak. The key question over here is IndusInd Bank actually returning to profitability this time around after posting a loss in the fourth quarter of FY25. The profit, however, is expected to dip by around 70% and come in at 653 crores. NI is expected to see a dip by around 14%. Your net interest margin, that number is seen at around 3.57%, which is higher versus a 2.25% if you have to compare it on a sequential basis. And the provisions are expected to go up by around 36%, and that number is seen at around 1,424 crores. Now, apart from that, if you talk about the business update that they gave in, it was slightly weak at that point in time, where the advances were down 4% on a year-on-year basis and down sequentially. And similarly, deposits have also seen a degrowth on a sequential basis. However, they have remained flat on a year-on-year basis. Talking about the pre-provisioning operating profit, that is expected to come in lower this time around. Credit costs probably could remain elevated as well, because in the March quarter that number was around 2.8%, and overall an easing of around 90 to 100 basis points is what is on the cards, but still that number will be elevated. Gross slippages, there could be some bit of a decline that could be coming in there, but again that number is going to be elevated. Net interest margins as well we already spoke about, so that's going to be a monitorable. Apart from that, the progress with regards to appointment of the bank's new MD and CEO is something that the street will be watching out for. The guidance in terms of the bank's pace of net interest margin expansion is what the street is eyeing. The MFI asset quality as well as the growth trajectory are few of the key monitorables that the analysts and the street are watching out for so far. But clearly a number that the street is closely looking at, because overall it's the derivative mess is what will impact this quarter.
Right, Hiral, thank you so much for that. And viewers, Sonar BLW, which has been in turmoil with a mother-in-law versus daughter-in-law situation. Remember, the company had in its exchange filing stated that Rani Kapoor, mother of the late Sanjay Kapoor, was not a shareholder in the company. Vishwanath Nair, my colleague, joins us on the phone line with more details on this.
Right. So the clarification that has come in from Sonar BLW points out that Rani Kapoor has not been directly or indirectly involved, has had no role in the company since 2019. She's neither a shareholder, director, nor officer of the company. That's something that the company is saying. What they have said is that any insinuation that her approval was coerced or even required to do anything in the company, that is baseless and is legally untenable. What the company is also pointing out is that we have a very professional board and management that is running the company, and that it is not a family-owned business. In fact, as far as the appointments of Priya Sachdev Kapoor and Jeffrey Overly are concerned, which happened in the latest AGM, both those things were done with proper compliance with the rules and approval of the shareholders. So any statement saying that that was not appropriate would be completely wrong and baseless. What the company is also pointing out is that there has been a dissemination of false narratives and pursuance of a personal legal agenda by Rani Kapoor in this case, which is eroding shareholder value. What they're also saying is that such actions are not only reckless but deeply harmful to the interests of the company. So clearly a very strong statement coming in from Sonar BLW opposing any of the insinuations that have been made by Rani Kapoor. Remember, Rani Kapoor's lawyer, who spoke to NDTV Profit exclusively, was talking about the fact that there was a lot of doubt about how these approvals were taken from her. and that she has been raising this issue and had requested that the AGM be postponed. Whether they will take the legal route or not, that is something that we'll watch out for next.
Right, Vishwanath. Thank you so much for giving us that update on the clarification coming in from Sonar BLW. Viewers, 2025 is turning out to be a brutal year for tech companies worldwide. A sector which was once regarded as the cornerstone of job security and was a path towards upward mobility now finds itself in the middle of a seismic shift. July began with Microsoft announcing that it is laying off around 9,000 people from its workforce, followed by Intel as well. Back home in India, if you focus the picture here, TCS is the latest tech company to join the list. In fact, TCS, one of India's biggest IT giants, Tata Consultancy Services, fell nearly 2% for the day in trade today. Before we delve into the recent TCS job cuts, I will quickly go across to my colleague Himakshi, who will join us to first break down the recent wave of tech layoffs.
Absolutely, Malika. So another major blow to the Indian IT sector there. TCS is laying off about 12,000 employees, or 2% of its workforce, if we can say. So the company says that the move will help it become future ready. As AI adoption accelerates, demands slows and cost pressures mounts. But employee unions allege that the staff are being pressured to resign, and which also sparks calls for resistance there. But this comes on the heels of Intel's massive restructuring in July as well, slashing up to 15% of its global staff, or nearly 24,000 jobs. Now closing its automotive chip unit and cutting fabrication teams also across the US and Israel. Let me just also highlight that earlier this month, Microsoft announced its third round of layoffs this year. Now, removing about 9,000 roles, especially across the cloud, gaming and hardware, and even as it doubles down on AI. And Meta also cut 8,000 jobs in mid-2025, citing cost constraints despite hiring aggressively for AI roles. Now, this doesn't actually really stop here. Between April and May, Microsoft let go of over 6,000 employees, while TechCrunch also recorded over 24,500 tech layoffs in April and another 10,000 plus in May. So back in February, also over 16,000 tech jobs were cut. So all in all, by late July, over 1 lakh employees have lost their jobs, and they've vanished in 2025 alone. From TCS to Amazon, Salesforce to Google, companies are trimming teams, reskilling for AI, and racing to stay lean in a fast-changing tech landscape. So basically, it reflects that the market standards, what are the market standards for the young talent, but at the same time, it's also very alarming and concerning.
Right, Himakshi, definitely. It does sound an alarm bell on the IT workforce at the moment. And speaking on TCS perspective, the tech giant's decision to trim about 12,000 roles is the company's biggest ever job cut in its history, viewers. And at NDTV Profit, we have been covering the story relentlessly, both from the employee and industry perspective. Listen in to some of those voices, and for the full conversation, tune in only to NDTV Profit at 6 p.m. this evening.
Is this really something to blame on TCS? Because Harpreet Saluja, I'm coming to you on this, and I'm reading out the statement that you put out, in which you are saying that this raises ethical and legal questions. At the end of the day, Mr. Saluja, this is a private company.
12,000 is just not a number on Excel sheet or a spreadsheet. These are 12,000 jobs and 12,000 employees who are human capital to this organization. And if we are particularly talking about the mid and senior level management, these people have spent approximately 5 to 10 years or more than 10 years, tenure in this organization. They have given their blood and and sweat. They have given the best possible years of their lives to this organization. If you are making profits and in May only, if your CEO salary is going and it is getting raised by 4.8% or close to 5%, you're taking 26 crores of rupees per year as your remuneration, then why, when it comes to increasing the profits, the employees in the mid-level management or the junior level, they are taking the hit of this?
And big news from the world of automobiles. Members of the FADA, which is the Federation of Automobile Dealers Association, are asking the Reserve Bank of India for help. They say private banks aren't quickly lowering car loan rates, even though the RBI has cut its main interest rate. Public banks are passing on these savings to car buyers right away, but some private banks are moving too slowly. FADA wants the RBI to step in, make sure loan rates drop faster, and give small auto businesses a fair deal. Now, to discuss this issue further, I am being joined by Sai Giridhar, Vice President of FADA. Thank you so much for joining us, Mr. Giridhar. We really appreciate your time. I would want to start off by asking you first, has FADA engaged with private banks directly to address this issue, and what has been their response so far?
So, we have a continuous dialogue with most of the banks, be it private or be it public. And most of the time, the response is that the cost of funding is still high. It's going to take them some time to lower the rate of interest. But when we do a deep dive, actually, you see, the RBI from their stake, they've already done a remarkable job as far as reducing the repo rate. In fact, this is the fastest reduction in repo rate ever in the Indian history. Since February, if you see. But if you see the translation as far as the auto retail is concerned, the consumers are not getting benefit out of it. So probably we got the opportunity to get the meeting with the governor. We thank him for giving us this opportunity, and we could appraise him about this concerning issue, because if we lower the rate of interest for the consumers, it's definitely going to help the industry. And what we are talking about is an industry which is worth more than 9 lakh crore rupees. We do approximately 50% of GST collection, which is close to 3.32 crore rupees, and we contribute 7.1% to the GDP of India. So we were able to tell these things to the governor, and he assured us that probably he's going to look into this in a very positive note. And in fact, if we see the exact reason why the private banks have not been able to pass on this rebate is because most of the private banks today in India are doing funding on fixed rates. It's not on floating rate. Had it been done on floating rate, the interest benefit could have been easily passed on to the consumer. So our request is very simple, that the consumer should be given a choice whether he wants the loan on fixed rate of interest or on floating rate of interest.
Right, Mr. Giridhar. I actually also want to, just in order to understand this issue well, could you also help me out with the timeline for how long have these automobile dealers have been facing this issue from private banks, and when do you exactly expect this issue to be resolved, and what are the key milestones?
So it's basically not the time. See, when the repo rate has gone down, if you see the rates as far as the home loan is concerned, the rates for home loan has gone down. The expectation from the consumer point of view is the consumers are actually waiting on the brinks. Even they're waiting for auto loans also, the rates will go down. That's the general feel in the market. Just because the rates are not coming down to the expectation of the consumers, I believe ultimately purchase is getting affected. People are deferring their purchase decisions just on the heck of it that the rates would come down, and then probably they'll decide and they'll jump on to get in their new vehicles. That's one. Second, with lower rate of interest, probably the consumer has the flexibility of taking the higher models or probably going in for the more aspirational vehicle that he is wanting to choose for. And we certainly believe, any rate cut would definitely propel the industry. It will help grow the industry. And we want the same in our industry also. And since we are not getting any headwinds from the private sector banks, probably we thought it is best to address it to RBI and sought their help in this.
Yes, that definitely, that definitely makes sense, Mr. Giridhar.
Yeah.
I'd also like to ask you, what message then would you like to convey to stakeholders, including private banks, the RBI and FADA members on this issue?
So it was, the only message is that it was not only regarding repo rates. We in fact gave a representation requesting the governor on recalibration of the risk weightage. See, if you see today, all the banks, as far as auto loan is concerned, it is having a risk rate ratio of 1:1. So that means 100% risk is given to auto loan, wherein it's a secured kind of a funding. The default rate is bare minimal. As far as auto loan is concerned, when you compare it to home loan, the risk weightage is 0.4%. So it is 40% to the cost of the asset that they're funding. So we only requested the governor that probably the banks could be told to recalibrate the risk weightage. We even requested him that every bank is supposed to have at least 18% of priority sector lending, which is agri-based. So if the auto loans, which is given in the rural and semi-Indian, semi-urban markets, if that can be considered as the agri-based funding, probably it will help, because in rural India, we've seen it is just because of the want of finance, easy finance available. We've not been able to make that kind of headwinds. We have not been able to make that kind of inroads as far as the retail is concerned. So I think if more and more banks are willing to fund rural India as far as auto is concerned, that's going to definitely help. Today we see only a small fraction of private banks or small banks which are funding in rural India. So, and credit card charging of credit card fees, which is done by banks, that's also on a very high side. So we requested the RBI that for debit card, there are norms from RBI. If it's less than 2,000 rupees, it is 0.4%. It is above 2,000 rupees, it is 0.9%. If the same could be done for credit cards also, because as on day, banks charges and charges are exorbitant. If you talk about, they even go up to as high as 2.5%, wherein the margins for dealers are immediately wiped off, only on the charges which we have to pay for the credit card swiping.
Right, Mr. Giridhar. Well, with that, Mr. Giridhar, I'd like to thank you for your time and sharing these concerns with us on NDTV Profit. And we really hope that there is a resolution to this issue very soon. Thank you.
Thank you.
And viewers, moving on, the Ministry of Electronics and Information Technology has reacted to the layoffs at TCS and said that units working to align workforce capabilities with industry demands. Rishabh Bhatnagar now joins us with more details on this. Hi Rishabh, please give us more details on this particular commentary that has come from the ministry.
Right, Malika, an official word coming in from the Ministry of Electronics and IT on the TCS layoffs that have led to about a 2% workforce reduction at TCS, about 12,000 roles being eliminated. What the ministry is saying is that layoffs in the IT sector are considered a regular phenomenon, and that is because there are changing skill and talent requirements that have been ongoing for a while. But the essence is the fact that the Indian industry remains a net hirer of freshers as well as other employees. The government continues to say that they are making efforts to ensure that what the industry needs in terms of capabilities, that is being met through training, through other sort of initiatives that the government is taking. The government has highlighted that they have launched initiatives like the Future Skills Prime, which is a reskilling and upskilling program to equip IT professionals with emerging technology skills. What we also picked up from the government earlier on in the day was the fact that no specific concern regarding these layoffs was brought to them. And hence, there's no sort of jurisdiction that they can do since these layoffs are not considered illegal or in breach of any sort of labor laws. So that is what we're picking up, but the government stance remaining that they are trying their best to upskill and reskill youth to the current technological climate and what is required from them. So that's what the government has said on this TCS layoffs matter.
Right, Rishabh. Thank you so much for helping us understand the government's comment on these layoffs. But viewers, with that, it's all the time we had on this edition of Profit 360. But do stay tuned to NDTV Profit as we continue to give you a lot more news and updates.
हेलो
बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है?
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Hello and welcome to NDTV Profit. You're watching Know Your Company. Today on KYC, we are looking at Lodha Developers. The reason why we've picked a Lodha Developers is on the back of Q1 earnings, a good set of numbers that the company has reported on a year-on-year basis, but a sequential decline that has come in here. I'm Hiral Dadia and with me is Mahima Vachrajani. But let's quickly address why Lodha Developers today. Firstly, what has led to the sequential decline that we've seen in terms of where earnings are concerned? On point number 2, the other question that we will ask the management is about the India-Pakistan war. The management has indicated that this did lead to around 2 weeks of downtick in terms of execution. So how much is the impact in terms of quantifying it if you have to look at the financials? On number 3, you're talking about the first quarter FY26 pre-sales. That number is below the guidance. So what does this mean? Will it mean that they will not be able to meet that FY26 guidance as a whole or not? On number 4, the auditors have flagged non-compliance for NCDs. Now, what is the impact? Because here, you're talking about the security deposit that they have to leave for the bondholders or the debenture holders. That is not in line with the security deed. So what happens then? And the competition that they are seeing in the Mumbai metropolitan region, you have a lot of other developers that are coming in. The strategy, what they are going to look at in terms of Bangalore and Pune also is going to be crucial. And very lastly, FY30 guidance, what are going to be the key growth levers that you should be watching out for them to meet this guidance? So that's what we are looking at in terms of where FY30 goes. But let's shift focus in terms of the key parameters that you should be looking at. Firstly, before the parameters, we look at about the company in terms of what the company is doing in trade. Firstly, as we know, Lodha established in 1980s. It's one of India's leading real estate developer. They have strong focus, if you talk about residential projects, nearly 4 decades of experience is what you're looking at. They cater mainly to luxury as well as premium, and they've rebranded itself from Macrotech Developers to Lodha Developers. And this is after the stew, that Lodha Developers had with House of Abhinandan Lodha. Moving on, apart from this, if you talk about the other details, the markets that they operate in, Mumbai around 10% market share is what they had in FY24. Their flagship, and this is their flagship and dominant market, and the largest contributor to the pre-sales. If you talk about Pune as well, that's the second market that they operate in, third largest in Pune, and they're growing fast over there. Over 11% of their gross development value is planned from the Pune market. Moving on, when you talk about Bangalore as well, they've entered Bangalore in November 2023, and recently they moved from pilot to growth phase in the Bangalore market. They're around 4% of their FY25 pre-sales comes in from Bangalore, and they're aiming for 15% market share in the medium term from the Bangalore market. So hence we've said that strategy with Pune and Bangalore is going to be crucial for Lodha Developers. Very quickly, if you talk about their split, in terms of Pune 14%, Bangalore is 7%, and largest 70% comes in from the Mumbai metropolitan region so far, Mahima.
Right, so it's interesting because almost 75, so a lot of concentration in the MMR, which is actually heating up in terms of competition. So that's an interesting question to ask the management as to how competition is shaping up. But in terms of the key offerings, of course, residential real estate is their core business. Luxury premium is something that they concentrate on only in luxury and premium housing. In terms of the overall digital infrastructure parks that they have, that's industrial, warehousing, logistics and data centers, that uses the annuity income model. So that's one of the things that they have in their basket. There's also commercial real estate, which is very small as compared to where the residential real estate stands, but still select office and retail developments mainly as a part of mixed use of projects is what comes under them. In terms of the overall facilities that are being managed by them right now, they're managing over 70,000 plus residential units. Recently also launched the Bellevue, a digital platform for integration of residential services as well. So that's an interesting one, and we have to ask the management as to how this is faring for them. There's also in terms of the product wise mix, in terms of Lodha Developers as of FY25, the mix in terms of the revenue, around 89% of the total chunk of revenue comes from property development. Then there is sale of land and development rights, which is 9.3%, and around 3.5% annuity and lease income, which generally comes from the digital infrastructure parks. Now, in terms of the overall key projects that the company is looking at right now, there's the Palava project, which is India's largest city-scale greenfield development project, and this is located on the outskirts of Mumbai. So again, one big project that they have in the MMR region. Then this is designed for walkability, sustainability, as well as an emerging data center hub. This is something that they're aiming along with the overall project. In terms of the Upper Thane region, that's the another Upper Thane project, which is another big project on their cards, which is a large township development positioned for long-term and high-margin growth. So this is something that is going to be a margin accretive project for them. And then there is one Lodha Palace, which is 100% renewable powered, grade A commercial complex, and it's one of the company's headquarters as well. So this is going to be a very interesting project to watch out for. This is everything that one needs to know about Lodha Developers so far.
Absolutely, and I think the key from here on is going to be the rating parameters that we are going to discuss right now for knowing Lodha. Firstly, you have the income statement check, operational matrix, balance sheet, cash flow. These are the top four. Moving on, we will be talking about their shareholding, their street credentials, the street coverage, as well as the outlook that the company has from here on. But let's start with the first one, which is the income statement. If you look at the revenue, EBITDA, margins, and net profit, that's the crucial aspect wherein you've seen a growth of around 14%. That's the 3-year CAGR. EBITDA has seen a growth of around 15%. Again, that's the 3-year compounded growth. Margins have been in that range of 35 to 36%. So that there you've seen some bit of stability that has come in. And the profit has grown faster than your revenue, which has seen a growth for almost around 30% on a 3-year compounded basis. So a strong number coming in on that front. Your margin trajectory, if you talk about it, that range again has been between 31.4%, which they achieved in FY23, to a high of around 36.1%, which they achieved in FY25. The first quarter of FY26, if you talk about that, the margin has been in that 28 to 29%. Now, whether they are able to cover up this gap in the next 3 quarters is the question that we need to check with the management, because if they are not able to do that, there's a potential for them to miss that 31 to 36% kind of a band trajectory as well. Moving on, if you see in terms of what has not worked, sequentially they've seen a degrowth in terms of revenue, EBITDA, margins and profitability, and I think that's what the street is reacting negatively to, because year-on-year basis it's a strong number that the company has reported. Revenues have seen a growth of around 20 to 22%, margins have expanded and come in at around 28.2%, and your net profits have seen a jump of almost 42%. So year-on-year, good growth. Sequentially, there has been a downtick, but I think the management will be here to answer that question. But overall, a thumbs up.
Right. So, it's the same has happened with key operational metrics as well. And that is because that is one of the reasons as to why the revenue is also impacted in terms of where the year-on-year number stands. The guidance was to achieve a growth of 20% in terms of pre-sales for FY26 as a whole. But this quarter, the overall pre-sales growth is around 10%. So the key question would be whether they'll be able to achieve the overall 20% guidance by FY26 or not. In terms of the yearly change in terms of how operational metrics have fared, pre-sales has seen a good growth of 21%, collections also a good growth of 29%, collections in terms of quarterly performance, the YY growth has been around 7%, so slightly lower in terms of where the quarterly performance stands, but overall a good growth when it comes to over yearly performance as compared to FY24 where FY25 stands. So because the overall yearly performance has been good, and generally real estate companies need to be seen from a yearly basis, we've given a thumbs up when it comes to the key operational metrics.
Right, so that's with the operational matrix, but let's quickly look at the balance sheet. It's very interesting to see how the balance sheet of this developer is panning out, because you've seen an expansion in terms of the equity. From a 480 crores, it's been stable over the last 2 years, that's FY24 and 25 in that 1,000 crore range. Other equity has also seen a sharp improvement. The book value has also nearly seen a growth of around 80% if you have to compare from FY23 to FY25. The borrowings, what's interesting, has nearly reduced from 9,050 odd crores in FY23. It's come down to almost 7,080 crores in FY25. So that's one of the positives, because of which if you see their debt to equity as well, that's been in the pretty manageable range what the company has guided for. The only thing which is dwindling is in terms of the cash and bank balance. If you have to compare to FY24, their FY25 cash and bank has come down to 2,320 odd crores versus a 2,950 odd crores. But if you have to compare it to FY23, it has improved. So on an overall basis, the balance sheet is still looking strong, and that's the reason a thumbs up on this one.
Right. Moving on to the cash flow statement, it's an interesting one, because if you see the overall picture of operations from cash flow, that has been on a declining trend from a 2,750 crores in FY23 to a 1,500 odd crores in FY25. So that's been on a declining trend. Overall, when we take a look at the percentage of operating cash flow to EBITDA as well, that's been on a declining trend and almost come down from 93 odd % to 32 odd %. So that's almost 1/3 of what it was doing in FY23. And because of this reason overall, plus net cash flow has gone to negative, but that's also because they've repaid borrowings in FY25, and that's the reason as to why the net cash flow position in FY25 has gone into that negative territory. But overall, considering the declining operating cash flows plus the cash flow to EBITDA, operating cash flow to EBITDA ratio declining quite sharply, we've given it a thumbs down when it comes to the cash flow statement.
So that's the cash flow. Let's look at the shareholding. If you see in terms of where the shareholding pattern goes, the promoters have reduced stake from 75% to 71.9%. FIs, though, have been increasing stake from a 19% to a 24.6% in the last 3 years. What's interesting is you have your DIIs, which is your mutual funds, have been reducing stake to an extent, not a major one, but from a 3.7% to a 2.4%. The only concern is the public free float. It's pretty small, 2.3%. It's come down to around 1% right now. So the liquidity with regards to Lodha is not very strong, but it does not really give you a bad picture taking into consideration your FIs have been increasing as well. Promoters are not selling to that extent, and that's the reason a pretty neutral looking shareholding pattern is what we're looking at right now.
Right, so in terms of street cred, you know, the stock has not done much in the past 1 odd year. It's down around 9 or to 10 odd % in the past 1 year, and 5 years also. It's not been that sort of multi-bagger that we've seen in a lot of counters. It's up around it's given returns of around 366 odd %. So we're taking a conservative approach here and giving it a thumbs down when it comes to street cred.
So that's the street credentials that you're looking at. And very lastly, if you see in terms of street credentials as well, the coverage, I mean, you have 13 buy ratings, 4 hold and just 1 sell. If you see the upside, it's almost 21% on a consensus basis from the current market price, so a strong number coming in. So a pretty neutral coverage that we're picking up there.
It's a strong outlook, you know, that's the last parameter, because companies remained on track. FY26 pre-sales guidance of around 21,000 odd crores. It's added 5 new projects with a gross development value of 22,700 odd crores. Has achieved 90% of FY26 guidance already of 25,000 rupees, 25,000 crores. Expects collections to be stronger in second half of FY25 is something that the management has guided. The new project additions to reach 250 by FY26 is something that the management has guided for. And an interesting one that I observed in their presentation was the 2020 action plan by 2030. That's focused to deliver 20% pre-sales CAGR, as well as to deliver 20% ROE with net debt ceiling of around 0.5 debt to equity is something that the management has guided for. So this is the overall outlook that the management has given so far.
Absolutely. So now let's look at the final performance rating that NDTV Profit has given a Lodha. Income statement, operational matrix, balance sheet, a thumbs up. Cash flow, as Mahima explained, is a thumbs down. Shareholding street coverage is an absolute neutral. So your credentials are a down and your outlook again is a thumbs up. So on an overall basis, you're looking at a rating of 5 out of the 8 parameters that NDTV Profit has looked at. But let's quickly address this with the management. We have Mr. Sushil Kumar Modi, Executive Director Finance at Lodha Group, joining in. Sushil, good morning and welcome to the show, and a pleasure as always to speak to you at NDTV Profit. On a year-on-year basis, a very strong set of numbers that have been reported by Lodha. I think what the street has taken negatively, at least at the beginning of the trading session today, is the sequential decline. If you could help our viewers understand as to what has led to the sequential decline and how big has the Indo-Pak war had in terms of execution, if you could quantify that for us.
Good morning, Mahima. Good morning. So nice to be there on the channel today to discuss the quarterly results and the performance. So, you know, to your point, just to first understand our industry. In our industry, generally, the performance of the second half is significantly superior than the first half, as in our country, the festivities coincides across pan-India into the second half. And housing is being such a phenomenal asset class and a wealth that is being perceived. People end up in consummating their purchases more and more coinciding with those festivities. So to that extent, nothing different. In fact, this quarter is the best ever quarter in terms of the Q1 that we have registered, and pretty much on track to deliver 40 to 45% of our yearly guidance in first half, just like any other year, and the rest 55 to 60% to come into the second half. So there is nothing perhaps that is unusual that one would notice when you see the performance, be it the pre-sales, be it the collection or our business development. In any case, you would have picked up the business development side. We ended up in doing 22,700 crore, which is 90% of our yearly guidance in the very first quarter itself, which enables us to kind of enhance our launch pipeline further, which at the beginning of the financial year, we had indicated to be around 18,000 crore. But for the fact that we have ended up in doing such a large scale business development in Q1, the total launches for the year as a whole has got enhanced to 25,000 crore from 18,000 crore, of which 8,000 crore we have already launched in Q1, and the rest, another 17,000 crore, is to come in the next 9 months. So thereby the launch pipeline is very, very robust.
So Sushil, we'll talk about the launch pipeline, but my key question over here is, you did mention that the 2 weeks of uncertainty due to the India-Pakistan war did have an impact. Otherwise, you would have performed much better. If you can quantify that impact for us as to how much is that going to be? And secondly, will it have any impact on your full year FY26 guidance? Because the pre-sales growth, yes, it's 10% to around 4,450 crores, which is below the company's 20% full year guidance. So is there any possibility that the 21,000 crore target could potentially be missed because of this impact?
So you said right. So to the extent our business being so granular, wherein we look for our sales week on week basis, and in fact our business perhaps amongst in the industry is one which is less and less to talk about the launches, but more and more to talk about the sustenance sale that we achieve week on week. Our sustenance sales up till last year was more like 250 odd crore on a weekly basis, which we have now enhanced and getting to the trajectory of more like achieving 300 crore. So if you see that, then to the extent we had some bit of a geopolitical tension within the country in last quarter that we are all aware of, automatically to say that the consumers ability to move around or think about consummating their purchases has got depleted then in those 2 weeks, and to that extent the sales of those 2 weeks did got impacted. So isn't it fair to say that perhaps we could have achieved another 3-4% higher sales, and thereby instead of growth of 10% potentially would have been more like 13-14% growth YOY? Yes, definitely it would have been possible, but nonetheless, knowing pretty well that the 9 months are still ahead of us and the launch pipeline being so strong, the interest rate trajectory having gone down significantly, as we know, RBI has reduced the interest rate by around 150 bips in last 6 months,
right?
And the income tax benefit also kicked in this year by the government.
Correct.
So all of those combined creates a phenomenal environment for a brand like us to deliver and capture the demand that is humongous sitting into the country. So we remain absolutely confident of achieving 21,000 crore sales guidance that we have given for the year.
Okay. Mr. Modi, just want to get your sense on competition. Just give us a sense of what's the kind of market share right now that you garner in the MMR region, and considering the entire space of MMR region is heating up when it comes to competition, especially in the luxury and premium space, what's the outlook like? Do you see some threat when it comes to competition?
Frankly, we need to understand the industry a bit differently. The fact of the matter is this industry is going for a robust consolidation. The consumer, having burned their fingers big time in pre-COVID era, is no more buying from any tier 2 developers, and which is what has created a phenomenal opportunity for the tier 1 top-notch players to kind of come in and take that market share and consolidate this industry, which obviously is healthy. So much so that pre-COVID, perhaps we were more talking about just touching double-digit number in terms of the consolidation, which has now, at the end of the last year has come to around 30% handle. So which is very healthy, and we are moving towards furthermore consolidating. So to that extent, some of the players, and in fact, that's a bit of a crisscross, right? The players from south or north coming to Mumbai, or Mumbai players going to reach south or or north, including us. We have gone, as you know, is into the south in Bangalore and doing phenomenal. In fact, we have now entered into the growth phase in Bangalore, where we are aiming for doubling our sales in the current year in Bangalore to achieve more than 2,000 crore perhaps. So to that extent, it is healthy. It kind of it takes away the market share and make the so-called tier 3 and tier 4 players out of the system, and creates a healthy pipeline, thereby the supply and demand all being sanitized. So that's healthy.
Okay. Sushil, my last question coming to you is your 2020 action plan by 2030. Are you on track for that? Because you're focusing to deliver around 20% pre-sales compounded growth and a ROE of 20% with net debt ceiling of 0.5 times debt to equity, which you're way below that right now. So that is one aspect. And the second question from my side to you is, in terms of the NCDs, auditors have put out a red flag that the security that is needed to cover the NCDs has not been enough this time around. What would you have to say on that?
So you have few questions. So to start with, in terms of end of the decade, our guidance of achieving 50,000 crore sales, which is nothing but achieving 20% CAGR growth year on year. And to that extent, we remain confident because we have set the stage for ourselves to be only looking for 20% growth, not higher than that, though the opportunity perhaps exists. and which also will come as a combination of potentially 5, 6, 7% from a price growth year on year, ensuring that the prices remains affordable and robust in the ecosystem, enabling the consummation of the purchases from the consumer side. That allows us to have only seeking more like 13 to 15% of a volume growth. And now entering into the Bangalore and potentially getting into the NCR in next year, that set the stage for ourselves to be so much so that margin of safety that we have created for us to deliver 50,000 crore sales is more like 40%, because taking into account our market share target, which is more like 20% for Mumbai, and any new city that we get in is more like 15%, we have an opportunity to actually deliver 70,000 crore of sales by the end of the decade. But we are only aiming for 50, which means we have the margin of safety of around 40%. So that kind of makes the business far more robust and granular. And as I said, our sustenance sales capability to deliver week on week ensures that we are in any case no more so much dependent on launches. If you look at overall environment where the interest rate trajectory in the country is so low, the inflation is all in control, that is the effective setup that this industry needs. And the fact that the home ownership in the country of an organized housing in any case is more like 22-25%. This is perfect set to kind of grow, with the economy growing anywhere around 6-7%.
So Sushil, all of that said and done, what about the auditor report which is stating the security cover available for debenture holders against the outstanding listed entities is not in line with the debenture trust deed? What would this mean, and where is the discrepancy?
Frankly speaking, that is our strength, right? Because we have got the AA rating from all the rating agencies, starting from CRISIL to ICRA to India Rating. That suggests that now the lending ecosystem, be it banking ecosystem or a capital market, in fact now NCD when you talk, that means it is getting into the capital market, which we have commenced now to diversify our debt pool of capital that we want to be keeping, which in any case is very conservative. So that doesn't need that much amount of security, which in the erstwhile period perhaps a lending fraternity would have been looking or expecting from Lodha. So that's kind of is a strength of ours, and which is what you see in terms of our cost of fund, which has gone down by 40 bips in this quarter. In last 3 years, every quarter our cost of fund has continuously going down. In fact, our newer debt is now being raised below 8%, while the exiting cost of overall debt weighted average was more like 8.2. So that means you are going to further see continuously every quarter our cost of debt continuously going down. Just to kind of set few things right, because I saw you indicated our margins are going down. That's not the case. Our EBITDA margin adjusted with the interest, because in our P&L cost of goods sold, there is an interest element also because of the accounting issue that is there. If you strip that out, then actually our EBITDA margin for the quarter was around 34%, which is pretty much in the band of the 31 to 36 that you were mentioning.
Correct. So 31 to 36% is the band, and it's in line with that if you have to remove and change the accounting method. But thank you, Sushil, so much for joining us on the show and sharing the views, and that gives a clarification that in terms of the security cover for the NCDs, that's not an issue, and that's a positive that the management is looking at. But completely out of time, but that it's a wrap on this edition of Know Your Company. Please stay tuned to NDTV Profit for more.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसा हल्का सा भी खौफ नहीं है.
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Select live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसा हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold ICICI for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Caller.
Hi, thanks so much for joining in. We're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. We've got a great show lined up for you. On the one hand, we're talking about something that one of our viewers, one of you, pointed out on social media. And we were discussing about balanced advantage funds last week. And one of you said, why don't you look at balanced advantage funds and compare them with multi-asset funds and talk about what the commonalities are and what the differences are and what you would use each of these categories for in your investment portfolio. And in the second half of the program, we'll talk about what you should bear in mind, one, before you choose to buy an electric vehicle, and two, if you are in the market for a second-hand car, as a lot of people are, then what is the checklist that you should follow? But let's start with the first conversation. We got Sharad Tandon, who's the founder of Invest at Ease, joining us at the start. Sharad, thanks so much for taking the time. Let me start with that question. It's a pretty basic question, but I think it would benefit a lot of people. What is the difference between a balanced advantage fund and a multi-asset fund, and how would you use the two?
So, both of them, as the name suggests, are a combination of two sorts of asset or more assets. So, balance includes equity, debt, and to an extent arbitrage fund to maintain the taxation advantage. While multi-assets, you can have equity, debt, commodities, and also foreign equity. Now, both these product categories are slightly more riskier than the pure debt fund. Balanced advantage fund is slightly a notch higher than the pure debt fund. MAF or multi-asset fund is a slightly higher than the balanced advantage fund also. For people, generally, the guidance is, if you're looking to park your money in, say, fixed deposits for more than 12 to 18 months, BAF is ideal like-to-like performance. The only sense of being cautious there is, it will be slightly volatile, unlike a FD, which is a straight return. It will give you more or less in the range of 8 to 12% return, depending on timing. If you're lucky, like last 1 year, where equity was slightly stable or positively biased, and interest rates were falling, your BAF will give slightly far more higher than the FD returns. While in the multi-asset funds, you need to be cautious of 2-3 things, in the sense, when as an investor, I am looking at sort of creating a bucket for myself individually in multiple schemes. Instead of that, I am taking a particular fund. So in that light, I need to be very cautious of what sort of fund I am selecting to invest. It will be slightly more risky than BAF, but better than the lot of other options we have like pure equity, which are extremely volatile.
Get into the nitty-gritties and how to select, because as I understand it, in the balanced advantage fund, the relative commonality of strategy is more than in the multi-asset fund. The divergence of strategy is more in the multi-asset fund strategy, because the requirement is to have at least 3 asset classes in your multi-asset category, and the stipulation is to have at least 10% in each of these 3 categories. And so therefore, it's a pretty open landscape for a fund manager to choose from. So when you're talking about the balanced advantage fund, how do you select? And then we'll get into multi-asset.
So for the advice which we typically give to all our investors on the balanced advantage fund side is, and that's an empirical guideline. So please look at your own risk profile before selecting the funds. We probably, to enumerate my point, we'll probably take some examples there also. So balanced advantage fund, I'm looking at slightly more risky than the FDs, a notch higher, but my risk profile is still low to moderate. Now, I need to be cautious of the fund manager with a longer track record, and a consistency is important rather than volatility. So our advice is generally to look at a larger fund houses like Prudential or say SBI or SDFC or say Nippon. While if you look at pure absolute return, there are new fund houses like Mahindra and White Oak also who have done purely absolute return in terms of performance. But for me individually as an investor, what will I look? If the equity profile of the equity portion of the balanced portfolio is matching my need, and typically in the BAF fund, our advice is stick to the fund which holds the large cap funds, large cap stocks. In the debt portion, because it's slightly, I want a security, I will look at a portion of the debt which gives me slightly lower end of maturity rather than longer end of maturity in case interest rate cycles move negative to us. Because in a debt, the valuation returns are like a seesaw. If interest rates go up, your returns are high. If interest rates go down, your returns are go up, returns are low. It's inversely proportional. In that scenario, we need to be cautious of these two, and how much of the portion of equity allocation is part of the arbitrage. Because arbitrage is very safe, defensive sort of bucket within the portfolio. And I'm saying safe because fund houses cannot carry a naked long or naked short depending on their view. And at the end of the month, the maturity of the expiry of the futures, the price point and the market value will come to and meet.
Yeah.
So you are only making returns on that volatility.
So therefore, with all of these parameters in mind, Sharad, and I'm not asking you to have recommendations, but based on these filters, which schemes are top of mind?
So for us, the way we look at it, in this set of BAF, if you look at as an investor, there can be 2 categories of the investors, which are one is bucket which is slightly okay with the volatility, and one is a bucket which wants a very defensive. So in the defensive category, the top of the chart which comes to the mind is something like Prudential BAF, because they have been very dynamically managing their net equity exposure. And we can look at last 7, 8, 10 years record, you will find that. Now, in the BAF, the other category is, which is slightly aggressive. So which is your something like say Axis BAF or SBI BAF, which are large fund houses, Nippon BAF. But in the equity portion, they might still go with some mid and small cap exposure and probably play on the duration of the fund on the debt side also, which can result in slightly far more volatile compared to Prudential.
Okay, understood. Now, multi-asset you've spoken about can be slightly more volatile. And so therefore somebody has to bear that in mind, and 3 to 5 years is what you've identified as the ideal time frame to hold something like this. What would you look at? Because as I've mentioned, the strategies can be pretty diverse. Something like a White Oak Capital has traditionally had more gold. Something like an Edelweiss multi-asset fund has had more arbitrage. So how would you look at it?
So perfectly captured, Alex, on that side. So how do we look at multi-asset? Because it's a combination of different risk profile within one namesake. So let's go take some example and we'll elaborate on that. For example, a Bajaj Finserv, a new fund house, say probably with a lesser legacy, not the group, but the fund house itself, plays only with debt, gold, silver, equity. That's where it will play into. Someone like, say, Nippon multi-asset fund will play in the foreign equities also. While someone like, say, Prudential will play into silver, gold, and base commodities like copper and agri also. While someone like Edelweiss, as rightly pointed out, will be far more conservative with the arbitrage being a larger portion of allocation. There are examples in the fund houses where you will find something like people taking exposure to currency also as an asset. Now, as a retail investor, the problem we face is we might know an asset class, 2 asset class, 3 asset class, but not a combination of all. And how of these all asset class are correlated to each other, whether directly, inversely, and what is the difference in terms of convergence ratio in terms of their performance. For us, the way to look at it, each of these cycles, whether it's interest rate or a metal cycles, typically takes around 3 to 5 years of time period to play out. If you're lucky and you've got into a mid-train, and probably 2 years is where you'll make money. If you are unlucky, you will start and you'll have to stay 5 years. That's where we say ideal scenario, 48, 50 months, 60 months sort of scenario to hold ideal.
Again, because of the changes in the way that these funds are taxed, they become more attractive, don't they? And fund managers do tweak things to make them more attractive post-tax as well.
So not necessarily. So the catch there is because foreign equity still is considered as a debt allocation for tax purposes. So for example, in Nippon, their constant equity exposure is to the 50 odd plus minus 2, 3, 4 percentage point depending on market valuation. But the rest 15%, 20% goes to foreign equity. So more often than not, you'll find something like Nippon MAF, a slightly stable fund because they will ensure the equity allocation doesn't exceed, but it will not have the tax advantage of equity taxation. While in some other funds like Prudential or say Axis or SBI, you'll have the advantage there. BAF is very clear. Most of the fund houses maintain more than 65% allocation of equity and arbitrage put together. So for all practical purposes, if you hold beyond 12 months, long-term capital gains, less than 12 months, short-term capital gains, and that's how it will be treated.
Okay.
But the best part is, and Alex, I'm just adding this point on this is, if someone is looking at doing a sort of regular income, because these are the risk profiles of clients who are slightly moderate to low risk, the SWP sweetens the tax impact. It reduces the tax impact. You can do a reverse of SIP.
Yeah, that makes a lot of sense. And also the other tax aspect that you need to bear in mind is that if you are shuffling between fixed income and equity, then you don't have to do that, and you don't have to pay the tax at each point because the fund manager is doing that for you, and so there is no tax implication. Sharad, thanks so much for joining in, and this has been an insightful conversation.
My pleasure, Alex. Always pleasure to be with you. Thanks, Atanbal.
All right. So that was to the specific question that one of you had to compare the two, multi-asset funds as well as balanced advantage funds. But that brings us to the second part of today's show, and I'd like to talk to you about automotive purchases. And of course, the headlines a couple of weeks back or last week was Tesla launching in India, but there's so much to choose from in the electric vehicle space. And also, I was having a conversation with somebody recently, and they're saying, oh, it's getting terribly costly to go to office in a cab every day, and they're thinking of buying a second-hand car. So what are the economics of it? What do you need to bear in mind? I'm joined today by Hormuz Sorabji, who's editor at Autocar India. As you probably know, you probably recognize him. Hormuz, thanks so much for taking the time. Let me start with that first conversation, right? Electric vehicles. I must confess that I have been hesitant to go for electric vehicles, and I say that my next car in probably 4 or 5 years might just be an electric vehicle, because I don't know where the technology is right now, and I think that the technology might just change very dramatically. What do you think somebody should bear in mind before buying an EV?
Well, I think, clearly, as you said, the tech in EV is fast evolving, but that doesn't mean, today's EVs are anything but good. In fact, I think as city cars, EVs are an absolute no-brainer if you have the possibility to charge at home, because charging in public places is still not very convenient. But if you have a facility to charge at home or in your building, your society, they just make absolute sense. The only downside really I see is the resale values of EVs are not great. We've seen that residual values plummet. But I think net, just the way they drive, the fact that they don't pollute, which makes me feel good, and the fact that they're pretty reliable, though there are software issues on certain brands, but not all brands. I think the time is right actually to jump in for an EV if it's just going to be for city commuting.
Let's talk about a couple more then, because Hormuz, I would imagine that the maintenance cost of an electric vehicle would be lower, because you're not worrying about oil, and you're not worrying about how good your engine is running, various other aspects. If the battery is okay and your powertrain is okay, you're okay, right?
Yeah, that's right. So I think typically the normal, let's say service parts like oil, filters, all that, you don't have to worry about in an EV. But of course, there are two factors on it. One is, of course, the life of the battery, which still for many is a concern. But, as technology improves, everyone's giving an 8-year warranty. That doesn't mean the battery only lasts 8 years. It means it's covered for 8 years. You will get a drop off in performance after 8 to 10 years, which is quite natural. But I think, if you keep the vehicle for so long, you will have more than recovered a lot of, the cost penalties just by way of how cheap it is to run. The other issue which there are with EVs right now are software issues. We've seen that, especially Tata Motors has had a lot of software issues and been a lot of complaints on that. So again, but this is, something you can with an OTA improve. It's not hardware. So I think the beauty of software is that you can continually keep updating the cars with the latest software. And that also can be fixed, though I must say the EV industry is going through a little bit of pain right now in this transition, where they're trying to, just make sure that the software works properly towards what we call a software-defined vehicle, where finally the software will be controlled by one central unit rather than multiple pieces of software trying to talk to each other, and that's where usually the problem comes. But I think overall, other than this, EVs in terms of maintenance are much lower than ICE vehicles.
Would you say that at this point, and Hormuz, we've spoken repeatedly over the course of the last several years, and I remember one particular auto expo in New Delhi where everybody came out with an electric vehicle. That was the time where the Mahindra E20 and nobody else had launched, right? And then suddenly you saw a flurry. So would you say that conclusively right now, Hormuz, at least for city driving and in the vicinity of a city driving, that range anxiety is out of the window?
Absolutely. I think for city driving, EVs are an absolute no-brainer, because really you don't even have to charge it every day. But I think, again, there's a rider to that. You should have access to easy charging, because that sometimes can still be difficult. Today, societies are hesitant to, let you set up a charger. They seem to be the biggest bottleneck. In fact, there should be a PIL, for a right to charge. I think you should have the right to charge. And I think that's very important for really large-scale EV adoption to happen. So if you have easy access to charging, EVs in the city is an absolute no-brainer.
I mean, if you go to London, then you have even street lights where you have the facility to charge overnight. I wonder if that is something that down the line can be facilitated. But there is quite a range of options available. Now, Hormus is talking about the money that you put down to buy an electric vehicle. They're not exactly cheap, but they start relatively affordable and they go to the obnoxiously priced. So I'm just wondering from the technology perspective, ultimately you're buying a great battery. In the case of Tesla, you're buying the availability of fast charging, which is not really available right now, but the possibility down the line. Is there really a very dramatic shift in what you receive as a buyer if you're putting double the money you would pay for, say, a Tata?
Well, I think, I have to say that, it's the cost difference between conventional combustion vehicle, petrol, diesel, vis-a-vis EV is not as great as, one would have imagined. That's largely due to a fantastic policy by the government, which is to, keep GST at just 5% for EVs. Now, clearly, the delta becomes narrower as you go higher up because the bigger ICE vehicles are taxed more, going up to 48 to nearly sometimes even 50% if you take all the taxes clubbed together, vis-a-vis, let's say, around just 28% for a small car, but that 5% remains the same. So for a big car, the tax difference is 48 to 5%, and a small car is 28 to 5%, much bigger for a bigger car.
I was asking within EVs itself, because it's a pretty wide range. If you're talking about starting from Tata and now going all the way to Tesla, you have the Iconic, you have Mercedes, you have BMW right on the top of the range. I'm just saying in terms of technology, and of course, these more expensive vehicles look absolutely stunning, but something like a Mahindra and Mahindra has come out with a beautiful looking car. I'm just saying in terms of technology, is there such a dramatic difference as you go up the line?
So I think, it's more to do with the battery size as you go up, and there is technology as well. And of course, there's the brand value. But I think that I would club it in two ways. You've got one set of, I would club it by range. You've got one set of EVs, which are really, at the lower end. And basically, they are city-centric. I mean, a classic example is the Windsor EV, which really has emerged as the best-selling EV. A real sweet spot. It's got a great price, under 20 lakhs. But it's basically for the city. Then you go above, you go into the closer to 25, 30 lakhs, and you've got, let's say, vehicles like Mahindra's range, which have really kind of, stolen, the market, in the sense a lot of people are talking about it. You're seeing a lot of them on the road. So there, especially the XEV 9e, which really is gives you the option of space, range, all the gadgets which you have. It's just absolutely feature packed. And now Tata have come with the Harrier EV, to contend with that. So that is a very exciting space, 25 to 30, really, where the Indian manufacturers have got a good grip on that market. Then you go up and you've got the foreign players. I think for me, the Hyundai Ioniq 5 is one of the best EVs, period, but it's a little pricey just because of the way everything works. There's a certain quality to it. So you get what you pay for in that sense. Clearly, as you go up, the volumes are small, so EVs then become imported, and an imported EV is much more expensive than one that is locally made here. So I think, in the 25 to 30 lakh bracket, you've got some choices there. You've even got BYD over there, which is an import and, giving you a pretty good product. You've got the Creta EV, which, again, a very sensible and sorted product, but doesn't have the wow factor of some of the Indian brands. And, today EV buyers want that tech. They want that wow factor, which sometimes is missing. So I think, to answer your question, I think, that 25 to 30 lakh, is a bit of a sweet spot where you get just about everything you want in an EV. You don't really need to go to a higher segment as well.
Yeah, so particularly if you're in the market for a 20-25 lakh internal combustion engine vehicle, the per unit cost of buying a 25 to 30 lakh EV might actually make a lot of sense if you have that charging infrastructure available. Hormuz, the second aspect that I wanted to speak to you about today is a lot of people out in the market going for a second-hand car. And I think this was a trend that started midway through COVID-19 or just after COVID-19, where a lot of these vehicles became available. From your perspective, as somebody that knows so much about cars, what should you bear in mind when you're looking for a car?
Yeah, absolutely. I think, the second-hand car market is booming right now. And frankly, what it's done, just to give a bit of perspective, it's really an alternative to an entry-level car. In fact, one of the reasons why the budget end of the Indian market, where the Maruti Altos are there and, the Wagonars and the Celerios is under pressure, especially Celerio Alto at the lower end, is because, you've got second-hand options. For that same money, you can get a decent second-hand car. And, today you've got really let's say you've got good platforms also like Spinny, which is, the leading used car platform right now. And apparently they've done record sales in the last couple of months. So clearly people want to look for a place where you can pick up something pre-owned reliably. And, something that even maybe comes with a warranty. So I think clearly the worry about buying pre-owned is what, the trust factor. So I think, so some of these platforms like Spinny take care of that. But if you're buying, let's say in the open market, the usual things you have to do is you have to have a look at the service history, what the service history is, where it's been maintained. I think the two areas where you can really be looking at big bills after you buy pre-owned, if you've not looked at, is the engine and the bodywork. Bodywork, if there's rust which has crept in, that's like cancer. It spreads everywhere, and then redoing the sheet metal can be a major issue. So again, the usual thing of just lifting all the floor mats, really inspecting the body for corrosion, inside, outside, underbody, all that has to be done. And I think, getting sure that the engine is in perfect shape also is important, because the last thing you want to do is open up an engine which is costly. Now, things like suspension, brakes, they're consumables. So, that can be replaced. But again, it's good to do a check, just do a general drive, look out for any strange noises that would come, even on the transmission, if the gear lever is, become a little loose, you can. So these are, there's a long checklist, to be honest, Alex, to go into that. But fundamentally, just to keep it simple, the body and the engine, these two parts of the car are absolutely important for, to make sure that these could be long-term big expenses. So make sure that there's no compromise on that.
Yeah, no, absolutely. I wanted you to go through that list. You've already hit quite a few of those points. But a couple of questions from my end, right? So you mentioned the body. Whenever there is an accident, Hormuz, in certain cases, what happens is that there is a cut in the body, right? So would you say that that's something to bear in mind, particularly for the door and for the allied portions or close to that area? If there is damage, then they have to cut that body and they have to then weld it back. That causes, whenever there's a joint, there is a problem. Would you agree?
Right, absolutely. So I think, and that's a good point, which I should touch upon, is accident damage, which can easily be covered up. Honestly, it's hard to really, if someone does a good job, it's hard to tell if the car is an accident damaged car or not, which has been done up. But there are certain telltale signs. The paint might be different in certain areas because the paint wears out differently. So the damaged areas might have fresher paint than the ones which are not so. Typically, if it's damage on the doors and all is fine, those are not stress members. But if it's had some sort of a head-on collision where the front cross member is damaged, then that could be an issue. This sometimes can show up in a wheel alignment or the car pulling to one side because clearly the suspension geometry has been affected by the collision. So but again, I think that's why it's just best to buy from a trusted source. Where these sort of issues can give you you don't have to worry about. And really at the end of the day, what a pre-owned car buyer wants is the maximum peace of mind, because 100%. We really don't know the background of the car.
100%, and that should show up in the service records as well, wouldn't it?
It would, but a lot of people give the car outside the let's say the authorized workshop, so that also becomes an issue. But as I said, now you've got certain platforms online. As I said, for example, someone like Spinny does a massive check. They have the expertise to get into every issue of the car. They've got their own workshops to do that. So then finally, what you're getting is a car that's been kind of already validated. So I think that's one way which to buy a pre-owned without having some sort of peace of mind. So I think. Yeah.
Final question, Hormuz, is there a sweet spot in terms of the kilometers run? Or you can have a car that's 5-6 years old that's run 20,000. So is there a sweet spot that you would look for as a buyer?
Yeah, I think around 25,000 is a nice spot where it's a good balance of the price and the mileage. So I think even between, let's say, 20 and 40,000 is what I would look at. Going beyond that, then there's more wear and tear and a lot more components which eventually would have to be replaced. Of course, those cars with higher mileage are a lot cheaper as well.
Yeah.
But I think there's a balance of price and low mileage, about 20 to 40,000 is what I would look at.
Yeah, and by the way, if you're buying a second-hand car that emerged from a coastal city, then you probably get a better deal, but watch out for that rust. Thanks so much, Hormuz, for taking the time. Pleasure speaking with you as always.
Thank you. Thanks, Alex. Bye.
All right, that brings us to the end of this edition of Your Money Matters. It's been an absolute pleasure bringing you this show, and thanks so much for tuning in. This is NDTV Profit.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है.
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold ICICI for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live. Ask.
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bahuguna. Now let's get straight into the show. So viewers, Monday blues for markets. Both Nifty and Sensex end the day in red. While Nifty 50 ends below the 25,000 mark, Sensex also closed 570 points lower. Most sectors ended the day in the red, with realty and media sectors leading the decline, dropping by nearly 4% and 3% respectively. So only the FMCG and Pharma sectors showed positive momentum, closing slightly up by 0.3%. TCS also to cut 12,000 jobs amid weak demand and cost pressures. So layoffs target mid and senior managers across divisions. AI not the cause, but wage hikes pushed ahead. So other IT firms also show mixed hiring trends in Q1 of FY26. Investec is bullish on TCS, sticking to a 3,705 rupee target despite headlines. So the 12,000 job cuts, about 2% of its 6 lakh workforce, are seen as routine, driven by a mismatch in the employee skills versus changing market needs. Notably, this move isn't linked to AI or panic cost cutting. While margins also may dip briefly, stronger billability and resource efficiency are expected to follow. Tata Consultancy Services plan to lay off about 12,000 employees from middle and senior levels between April 2025 and March 2026. So sources have told that no concern has been brought to government so far. Sources have also mentioned that private sector terminations are not under government jurisdiction unless there is unfair dismissal or breach of labour laws. Kotak Bank was the big stock in focus over the weekend as Q1 results revealed pressure on the key financials. So provisions surged 33% quarter on quarter and over 100% YOY. So largely driven by weakness in the microfinance book, while operational numbers remain broadly in line, margins compressed and profit growth declined. ROA also slipped below the 2% mark, though operating expenses helped cushion the blow. Tamilnad Mercantile Bank reported a 6% rise in the Q1 of FY26. Net profit also, to 305 crore rupees, driven by a 90% drop in provisions to 8 crore rupees, despite a 12% decline in the operating profit to 412 crore rupees. So net interest income grew 2% to 580 crore rupees, but margins fell to 3.8%. Deposits rose 9%, and advances grew 10.4%. So the asset quality has improved, with gross NPA at 1.22% and net NPA at 0.33%. So the bank aims for 15% advance growth and 10 to 12% deposit growth in FY26, expecting NIM stabilization. Macquarie maintains an outperformed rating on Titan with a price target of 4,150 rupees, citing strong brand equity and growth potential in the UAE and Kuwait through the Damas acquisition. So the brokerage likes Titan's focus on premium designs and lab-grown diamonds. However, slower EPS accretion and the exclusion of the Graph franchise, which is 20% of Damas's sale, are seen as drawbacks. Acme Solar has delivered a blockbuster Q1 performance. Revenue surged 65% year-on-year to 511 crore rupees, while EBITDA jumped 68.5% to 458 crore rupees. Net profit skyrocketed to 131 crore rupees from just 1.4 crore rupees last year. So this is driven by scale efficiencies and new capacity. Margins have expanded to a stellar 89.6%, which is nearly 90%. Orient Cement has crushed expectations in Q1. Revenue rose 24.4% year-on-year to 866 crore rupees, while EBITDA nearly doubled to 182.6 crore rupees. Net profit also skyrocketed 459% to 205 crore rupees, and margins expanded to 21.1% from 13.8%. Premier Energies shines in the latest quarter with steady growth and rising efficiency. The company continues to expand its clean energy footprint, powering a brighter future while strengthening its bottom line. So revenue rose almost 10%, while EBITDA surged 53%. Net profit climbed 56% to 308 crore rupees, and the margins have expanded to 30%. J&K Bank posts strong Q1 numbers with a 17% jump in the profit and margins shrink as deposit growth beats the loan growth. So interest income is up, but cost of the funds have risen faster. So asset quality stays steady despite the NPA provisions. Laurus Labs zooms post Q1. Net profit zooms 13 times year-on-year on the CDMO-led growth. Revenue also jumps 31% with sharp rise in the EBITDA margins. Gross margins improve on better business mix, and API weakness partly offsets the gains in the generic FDF. Wockhart's novel antibiotic, Zanuck, grabs the global spotlight after saving a critically ill US liver transplant patient. Now, the patient had pan-drug-resistant infections, unresponsive to all the available treatments. So Zanuck cleared the infection in just 11 days, enabling a successful transplant and chemotherapy resumption. So the drug has completed phase 3 trials and targets a $25 billion global market. Brigade Group launches its new premium residential project, Brigade Avalon, in Bengaluru's Whitefield area. Now, this project spans 4.36 acres and features 206 carefully designed homes with spacious 3.5 and 4 BHK configurations. Brigade Avalon offers a bold architectural identity with private decks, light-filled interiors and flexible home office spaces to suit modern living. So the development includes a grand clubhouse with premium amenities for all the age groups. GAIL Limited is filing an arbitration claim seeking up to 639.18 crore rupees plus interest against the Focus Energy Limited, iServices Investment Limited and Newbury Oil Company Limited. Now the claim have actually arisen from the non-supply of makeup gas and a shortfall in the supply of gas under 2009 gas sale and purchase agreement. So GAIL has formally submitted its statement of claim to the arbitrator, asserting that it's right to recover damages for these supply failures. Recently, the Delhi High Court has also directed the respondents to secure 158 crore rupees through a bank guarantee or assets to project GAIL's claims during the arbitration. Now, this legal move asserts GAIL's commitment to enforcing contractual obligations and protecting its financial interests amid the dispute. Dr. Reddy's Laboratories has made a significant investment of 565 crore rupees in its Russian arm. So Dr. Reddy's Laboratories LLC Russia, which is acquiring a 45.19% equity stake. Now, this infusion has completed on July 25th and is aimed at supporting the working capital requirements of the Russian subsidiary. So DRL Russia has demonstrated strong business performance with a reported turnover of about 2,347 crore rupees for the fiscal year of 2024-25. Now, this investment reflects Dr. Reddy's commitment to expanding and strengthening its presence in the Russian pharmaceutical market. Citi maintains a buy rating on Mahindra & Mahindra, raising its target price to 3,810 rupees. The firm highlights strong momentum in both M&M's utility vehicles and the tractor segments. So tractor sales have benefited from a healthy harvest season, while UVs are also performing exceptionally well, firing on all cylinders. M&M's volume growth is notably stronger compared to its peers, reflecting robust demand and solid rural market traction. J&K Bank reports its Q1 performance with key takeaways showing a sequential dip in the margin, faster deposit growth compared to advances, and a decline in the yield coupled with a rise in the cost of funds, while asset quality remains largely stable. So year-on-year, interest income has risen 9% to 3,268 crore rupees. Within the interest expense, the interest expense going up 11% at 1,802 crore rupees, and net interest income also has improved 7% at 1,466 crore rupees, and operating profit grows 13% to 673 crore rupees. Steel Authority of India reports its Q1 results with revenues declining 11.6% at 25,922 crore rupees. Now, just missing the estimates of 25,790 crore rupees there. So EBITDA drops 20.5%. Matching the expectations, while margins remain stable at 10.7%. However, net profit takes a significant hit, down 40.5% to 745 crore rupees against an estimated of 1,076 crore rupees. Now, this sharp decline is actually mainly due to an increase in the stock in trade as SAIL proactively stocks raw materials. Lodha Developers reports a strong Q1 performance with pre-sales rising 10% year-on-year to 4,450 crore rupees. Collections also grow by 7% year-on-year. The company maintains its full-year guidance, targeting 20% growth in the pre-sales for FY26. During the quarter, Lodha launches new projects worth 8,300 crore rupees, while Q2 launches are limited to a new phase at existing locations. Consolidated revenue also jumps 22.7% to 3,492 crore rupees, and EBITDA increases 30% to 984 crore rupees, with margins expanding to 28% from 26%. So net profit has surged 42% to 675 crore rupees. RPG Life Sciences has reported a challenging Q1 performance with mixed business segments. The domestic formulation business grows 9.5%. The API business takes a hit, declining 22.4%. Overall, the revenue edges up 2.1% to 169 crore rupees. So net profit also sees a marginal increase of 1.8% to 26.3 crore rupees. GMDC reports muted numbers for Q1, with a slight dip in the margins and profit also impacted by a decline in the revenue quarter on quarter. So the sales volume have dropped nearly 9.6%, which is reflecting a softer demand. Year-on-year revenue have also fallen 6.8%, while the EBITDA has decreased 12.6%. Margins have contracted to 23% from 24.6% previously. So net profit takes a sharper hit, declining 27.6% to 164 crore rupees. Overall, GMDC faces top-line pressures and margin compression in a challenging quarter. Cartrade delivered a robust Q1 performance, marked by impressive double-digit growth across the key metrics and strong margin expansion. The company has capitalized on its solid momentum in its remarketing and consumer segments, while the OLX continues to shape into a strategic growth lever, and that also makes it the stock of the day. Adani Green Energy reported a robust Q1 of FY26 with consolidated net profit soaring 60% year-on-year to 713 crore rupees from 446 crore rupees. Revenue jumped 36% to 3,800 crore rupees, which is up from 2,794 crore rupees, driven by a 41% increase in the operational capacity to 15,816 megawatt. So EBITDA has risen 28% to 3,042 crore rupees, though the margins have dipped to 80.1% from 85.1% due to higher expenses. The company has added that 3,135 megawatt in greenfield capacity, including solar and wind projects, reinforcing its leadership in India's renewable energy sector with a 50 gigawatt target of by 2030. Zen Technologies reported a 38% drop in Q1 of FY26 net profit to 47.8 crore rupees from 76.8 crore rupees, with revenue also down 37.9% to 158 crore rupees. So EBITDA has fallen nearly 42% to 65 crore rupees, and margins have contracted to 41% despite the dip. The company has maintained a debt-free balance sheet and a 754 crore order book management, which is led by Ashok Alturi. Atluri views this as a temporary adjustment, targeting 6,000 crore rupees of revenue over FY26 to 28. So the acquisition of TISA Aerospace bolsters its UAV capabilities with 150 crore rupees in the new order secured. US President Donald Trump announces a new trade deal with the European Union, calling it a good deal for everybody. So after high-stake talks in Scotland with EU chief, the US imposes a 15% tariff on EU imports. Now in return, the EU pledges $600 billion in investments and $750 billion in energy purchases. Now both the leaders hail the agreement as a breakthrough aiming to end a long-standing transatlantic trade dispute. The $2 trillion US-EU trade deal is turning heads across the global markets, especially in India's auto sector, with car tariffs slashed to 15% from 27.5%. Top Indian players like the Tata Motors, Samvardhana Motherson, Sonar BLW and Bharat Forge are poised to benefit. Now for Tata's JLR unit, exports from the Slovakia now face lower duties, while Bharat Forge and Sonar BLW could actually see improved margins on their hefty US-bound exports. Now this tariff reset configures supply chains and offers a competitive edge to Indian firms with transatlantic exposure. Bharti Airtel's data center division, NXTRA, has signed an agreement with Ampin Energy to procure an additional megawatt hours of hybrid solar and wind energy. Now, this renewable power will be sourced from plants connected to the interstate transmission system, and exchange filing says that the deal supports NXTRA's goal to increase the use of sustainable energy in its data centers to reducing its carbon footprint. The Tata Sons board is set to meet ahead of the annual general meeting scheduled for August 14. The AGM agenda includes approval of the company's financial statements and key appointments and reappointments. So Noel Tata is proposed to be appointed as a director and nominee of Tata Trust. Additionally, Mr. Venu Srinivasan, Saurabh Agarwal and Anita George are up for reappointment to the board, with Anita set to continue as an independent director. Amber Group's, through its subsidiary, has signed agreement to acquire about 40.24% of Israel-based Unitronics. Now, this deal is signed for 400 crore rupees. Now, the acquisition is also scheduled to complete within 2 months. Unitronics, which is listed on the Tel Aviv Stock Exchange, supplies industrial automation products such as programmable logic controllers, human-machine interfaces, server drivers, and SaaS solutions. Vietnamese electric vehicle maker VinFast has opened its first showroom in Surat ahead of launching its manufacturing plant in the country. So the company plans to establish 35 dealerships across at least 27 cities in India by the end of the year. To support its expansion, VinFast has formed strategic partnerships with Road Grade TVS and Global Assure to build a network for charging infrastructure and after-sales services. The Department of Telecommunications has issued a show-cause demand notice to Tata Communications for about 7,800 crore rupees over AGR dues. Tata Communications stated that in an official note that the demand includes amounts related to disallowed deductions under its ISP and NLD licenses, with appeals already pending before the Supreme Court. The company asserts its licenses are separate from those impacted by the Supreme Court's 2019 AGR judgment and says that it's based on legal opinion. It also expects to be able to defend its case. Indian Bank has received board approval to raise 5,000 crore rupees during the current financial year. So according to CEO Binod Kumar, the bank reported a rise in its capital adequacy ratio to 17.8% for the April-June 2025 quarter. The bank does not plan to use QIP or other instruments immediately. So in addition, Indian Bank is set to launch its own UPI-based payment app, IndUPI, so to reduce the operational cost. Now, the bank has also received approval to hire 3,000 employees this year across various levels. Security forces in Srinagar have successfully concluded Operation Mahadev, resulting in the neutralization of 3 terrorists. Among those killed was Suleiman Saha, who is known for his involvement in the recent Pahalgam attack. Officials have confirmed that the 2 slain terrorists were Abu Hamza and Yasir. So all 3 were identified as members of the Pakistan-based terror group Lashkar-e-Taiba. Following the operation, security personnel are conducting thorough checks of the commuters in the vicinity to ensure the safety of the area and maintain vigilance. The Delhi government is set to launch its Logistics and Warehousing Policy 2025, aiming to ease congestion, lower pollution, and improve the trade efficiency. The draft policy proposes creating dedicated logistic hubs, green firefighting corridors, and also deploying technology-driven solutions to the streamlined goods movement. Now, Delhi now handles about 10 lakh tons of freight daily via nearly 1.93 lakh vehicles. So, key measures include relocating warehouses to city outskirts and switching last-mile deliveries to electric and CNG vehicles. Thailand and Cambodia agree to immediate ceasefire for their border conflict. The fighting, which flared up last Thursday after a landmine explosion, has displaced tens of thousands of people on both sides of the border. Over 2 lakh villagers have evacuated their homes, with many now staying in the temporary camps. Now, a shocking act of violence has been reported in the Thai capital in Bangkok. At least 6 people are dead following a shooting incident at the Torkor market. Now, the fatalities include the gunman, who reportedly took his own life. The emergency medical center reports that 4 security guards and 1 woman were also killed in the attack. Now, the market, which is known for its agricultural product and local foods, is now the scene of a major police investigation. A regional passenger train has derailed in southern Germany, resulting in at least 3 deaths. Investigators are looking into the cause of the derailment. Around 100 people were on board the train when 2 carriages went off the tracks. Now, the crash happened after storms passed through the area. Authorities are working to determine if the weather has anything to do with it. Shubman Gill has etched his name in history, becoming the first Asian cricketer to score 700 runs in a test series in England. The Indian captain's gritty 103 in Manchester's 4th test broke Mohammad Yusuf's record of 631 runs. With an unbeaten century, Gill also joined Sunil Gavaskar and Yashasvi Jaiswal as the only Indian to score 700 runs in a test series. With that, viewers, it's a wrap on this edition of Market Express.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about
The India-UK free trade agreement will boost many textile players as tariffs are expected or reduced to zero, right? Not expected, but reduced to zero. Raymond is presumably one such player with a 22% garmenting business in the UK. We'll speak to the management in a minute, but first let's get in Mahima to set up the conversation for us. Mahima.
Right, so as you rightly mentioned, the textile space is set to benefit from the UK-India FTA, and this is because the duty was as high as 12%, which is now reduced to almost 0%. Duty-free access to UK markets will provide India a level playing field with competitors like Pakistan, Bangladesh, Cambodia, China, etc. Now, in terms of the overall UK exports from India, they are right now stand around 6.6%. Indian textile outlook is also very positive. The government is aiming at almost $100 billion US dollars by 2030 in terms of textile exports. Now, Raymond has said that around 20 to 22% of their overall exports happen to UK, plus the EU combined number is 20 to 25%. And this the overall expectation is that the exports that they do to UK could double in the near future. And FTA clearly puts India in an advantageous position. Now, I spoke to Amit Agrawal, Raymond Group's CFO, to talk to him about how this will benefit India as a whole and how this will benefit Raymond Limited as well as Raymond Lifestyle. Listen to that conversation. Before I go on to company specifics, just want to get your sense on how big an achievement this is for India in terms of signing a trade deal with the UK, and how beneficial is this for the entire textile space?
Thank you for having me on the show. No, it is a great thing. It's a big achievement. And we have been waiting for this FTA to happen for quite some time. And I think it is a beginning of the journey. If you see, if we have done with UK, over last 18 months, we have done with Australia and few other countries. I think as you see one big FTA like UK has happened, it will open up EU on the next line. I think that will enable us, Indian, to export much better. And when you are getting this status, you are actually becoming a level playing field compared to what you call having Bangladesh on your neighbor, Vietnam, Indonesia. Many of these countries have got a zero duty benefit. So when we were competing, and especially in a textile sector, when you compete, the margins are quite thin. So this would make a large difference. And considering this impact of the duty, which was in the range of 11-12%, depending upon the product to product, especially in the textile sector, it made us difficult to export into these countries. Only we were able to do a very high value product. And India has got an integrated supply chain, which I think is going to be a very large beneficiary. And it creates a lot of employment. Textile industry creates a lot of employment. So that all is going to be a big boost to the Indian economy and to our foreign exchange earnings. So I think we are very happy to have this done, because we believe it is the beginning of this journey, and we will see many more to come. And Indian exports can grow very fast.
Right, most certainly, Mr. Agarwal. I was going through your con call, and correct me if I'm wrong here. 20 to 22% of your garmenting business, comes from the UK. And just want to get a sense as to how this landmark deal benefits Raymond Lifestyle as a whole.
So look at it. In my opinion, what we believe in the Raymond has got a great opportunity with UK. Because first of all, let us understand, we are into wool, worsted, and an integrated supply chain. Right from the wool fabric we manufacture, then we convert them into garment for the big labels. And UK being a colder country, there is still a lot of traction for the woolen worsted suits. So that helps us in order to grow. Now, previously what used to happen was people would get the import of the fabric from China and other places into Bangladesh, get it converted, made garment, and then send it to UK. Now that will change dramatically, because people would like to see if there is an integrated supply chain company with an advantage of the lead time, as well as there is no disadvantage on account of the duty. I think we see that over the next 18 to 24 months, I think we should see our export revenues from UK to grow. But if I recall, it was not 20% alone to UK, it is UK as well as EU. That is the level of 20-22% is that number. And I think we should be able to grow in the UK business comfortably double itself. And this business is going to be much more attractive. We have already seen, because since the month of May, you have already got this traction that the UK FTA will get signed. And we have already started to see some of the inquiries coming from the people, from the customers. But any inquiry to get converted, because there is a season, autumn, winter, spring, summer. So it will take at least 8 to 9 months. I think what we can see is only in the next year, somewhere around the same time or a little later, the traction of actual deliveries to flow through.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है?
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold ICICI for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in?
When India's most trusted IT giant slashes 12,000 jobs, it's not just a concern limited to a single company, but perhaps sounds the warning bell for the entire IT industry and policymakers at large. Tata Consultancy Services, India's flagship tech titan with over 6 lakh employees globally, has decided to lay off 12,000 of its employees. That's about 2% of its workforce. It is its biggest ever job cut in history. Among those affected will be including mid and senior level management roles. Now, without explicitly blaming artificial intelligence for the job cuts, TCS has said the decision was part of a broader plan to become quote-unquote future ready, involving realignment of the workforce, AI deployment at scale, and new investments in next-gen technologies and markets. And if you look at some of TCS's recent moves, it all comes together. This is clearly not an isolated incident. Points perhaps to larger troubles that have brewing for a while. In the Q1 earnings concall, for example, TCS announced that it will delay wage hikes due to global uncertainties. Earlier in Feb, it reduced the quarterly variable pay for senior employees. It also tightened its bench policy, which now mandates at least 225 days of billing every year for employees, with the permitted bench time being reduced to a maximum of 35 days. The company was also under fire from the Labour Ministry for delaying the onboarding of 600 lateral hires. Now, for an industry that was once the beacon of job security, upward growth and mobility, this is truly a rude awakening and raises serious questions, because it's not just about TCS. Is this a transition to AI that we're seeing playing out? Will we see mass firings in other top IT companies as well? Are we going to hear from other bellwethers next? Is the firing of mid and senior level roles indicative of cost saving, or something much more? And have Indian IT companies failed to reskill in time for an AI shift? Were these 12,000 people who will be identified and laid off over a year offered the opportunities to upskill if that was what was required? Have large Indian IT companies underinvested in the AI transition? These are some of the questions that we'll be exploring in this show. Kamal Karnath joins me now. He's co-founder of Xfino. Ramani Dati, CFO of Teamly Services, with me on the show. I'm speaking with Harpreet Saluja, Advocate, Bombay High Court, and President of NITES, that's Nascent Information Technology Employees Senate. They've put out a statement also condemning what we've seen. Ashank Desai joins us, Chairman of Mastech and a veteran of the IT industry, really. Mr. Desai, I'm going to start with you just to get your sense of what is happening, how you see TCS's decision. Is it a one-off? Is it cost-cutting? Is this just a start of a tactic shift across the industry?
Tamanna, it's great to see you.
Likewise,
after a long time, not on TV. Of course, we see you very often. But coming back to your question, Tamanna, see, I think one has to look at IT industry over last 30-40 years, which is where I come from. And some of the inflection points that we have come across are not less. Just after Y2K, when this whole dot-com bust came about, there was this issue of slowdown and job cuts and so on. Then came 2008-9 financial meltdown. We saw an issue there. Then came, of course, COVID, and first reaction was about job cuts and so on. So I think one has to look at the context, is what I would first say that. So I think ascribing everything to AI may not be a fair answer to all this. The issues that IT industry is facing are not just AI. AI, of course, is impacting us, but it is also about the slowdown that are happening because of tariff and related issues in US and some uncertainties globally. So I think industry is trying to realign itself to the coming era of AI plus uncertainties in demand and so on, which have nothing to do with AI, as I said again, and then making those calls. So I think, and IT industry, as I said to you earlier, have passed through some of these three and come out well out.
No, that's
so I am coming from optimism that yeah, this will happen and we will come out very successfully out like all other challenges we had.
So Mr. Desai, I'm sure you're feeling optimistic as someone from the industry. There are a lot of employees right now who don't know if their number is up, who are definitely not feeling optimistic. There are various ways that we need to look at this, and one very important way to look at it is how the IT services industry and the high quality jobs they offer is something aspirational for middle class India. It also leads to an economic virtuous cycle. These are the people who are buying those expensive apartments and paying those EMIs and boosting that kind of consumption in the industry as well. So there's more to this than just what the IT industry is going through. I want to come to Ramani on this, Ramani Dati, and how you see this panning out in terms of jobs. This is not at the lower end. This is mid and senior level. If I add to this, Ms. Dati, on what is happening with beginner salaries in companies like TCS and others, those have not moved over the last decade or so.
Hi, Tamanna. Yes, definitely we are seeing a big shift, especially on the IT services side, because to some extent, IT services also haven't invested in upskilling their employees or even in reinventing themselves and moving up the value chain. So while they have right now come under cost pressure and other challenges with respect to decline in the overall discretionary IT spending and global headwinds, apart from that, during COVID years, many of the IT services also have expanded their overall capacities. Some excess capacities also have been built. To some extent, that correction has already happened over the last 2 years. But the ones that we are seeing right now is definitely a huge shift. And what we are noticing on the ground is that many non-IT companies are setting up their own internal IT teams. Earlier, they used to outsource a large part of their transformation projects and IT development projects to these IT services companies. But now many of the large organizations are preferring to set up their own internal IT capacity centers. So because of that, even like at TeamLease, in the number of hirings that we are doing right now, majority of the IT hirings that we are doing right now are for the non-IT companies. So it's not a complete bad news for the skilled IT employees, because the GCC hirings are good and senior level, mid-level IT hirings in non-tech companies are good.
But ma'am, will these GCC hirings absorb mid and senior level? They seem to be stuck in a dead end over there. Is there space for the manager level?
No, definitely it can't absorb and completely offset the numbers that we are losing on the IT services side. Definitely no, because the volume of hiring that happens in GCC and non-IT is relatively much smaller compared to the IT services hiring. But having said that, for high-skilled jobs and which are the niche technologies, there is definitely demand in GCCs and non-IT sector. If employees can upskill themselves and definitely on these niche skill set, there is a scope.
You know, Kamal, let me come to you on this and how you see this whole situation. TCS in its statement, and we'll pull up bits of that statement, saying that, you know, they're going to offer all kinds of support to the employees, etc. This is part of themselves being future ready. Do you see this as just a start when it comes to bellwether large IT companies? Because this is the biggest one, and if this is about protecting margins, then others will follow suit.
Tamanna, there's a bit of an inevitability around what's happening around us. If you look at the last 3 years per se, the clear tectonic shift has been the number of net additions, global capability centers in India have added. And I think clearly the IT services companies have missed that bus. If you look at the number of people, global capability centers added in terms of employees over the last 3 years, between them and the big four, the consulting companies also are in a way loan staffing companies. So they have sort of become competitors to IT services companies. So the last 3 years, the IT services companies added a net number of about 3.5 lakh people, whereas GCCs and consulting companies put together added close to about 5 lakh employees. So collectively, if you see, the IT services companies moved from what you can call as a base of 22 lakh to 25 lakh, number of employees in this time, whereas the GCCs and consulting moved from 16 lakh to 21 lakh. So I think clearly there is a bus that IT services companies have missed by not focusing enough on GCCs. And you can see that they've made a slew of announcements about, exclusive heads they've appointed to focus on GCCs. So if you look at the number of people employed by GCCs today, I could say that almost 50% of them could have been employees that IT services companies could have got. So that's one. Two, if you look at the global scenario, the global product companies, the FANG as we used to famously call them, the Metas, the Apple, the Amazons, the Microsofts, the Netflix of the world, and the Googles, they were one of the largest customers for the IT services companies. If you look at last two and a half years, they have cut down almost 1 lakh jobs in US. So in a way, that demand also has cut down for the IT services companies. Third, definitely there is a demand issue, tariffs, the wars, all put together has sort of slowed down, and these companies have been talking about discretionary spending coming down. And clearly, you cannot forget the threat of AI, which is looming. Yeah. Though you clearly see the attrition refilling numbers, though it still shows that linearity is still at play, and they have not really cut down too many numbers. But if you look at the first 4 things that I said, global capability centers, the consulting companies eating their pie, the product companies, the macroeconomic indicators, and AI put together, clearly is putting the pressure on the IT services companies. And like I said, there's a bit of an inevitability that we have to see this situation today.
So I don't know if it's a like for like in terms of the numbers. Yes, TCS in this quarter has said that they will have 40,000 people that they will add on in FY26. But then if you're letting go of mid-level managers, what happens? Just for an additional point here, when we're speaking to experts today, they're saying there was a time when managers in large companies like this would handle 5 to 7 people in their teams. Now a manager can handle 60 people, 50 to 60 people in a team. So your numbers are going to come down. My question is this really something to blame on TCS? Because Harpreet Saluja, I'm coming to you on this, and I'm reading out the statement that you put out, in which you are saying that this raises ethical and legal questions. At the end of the day, Mr. Saluja, this is a private company. This has a responsibility to shareholders, to its board, and its intent is to make profits. They are within their legal rights to cut jobs if they need to.
See, Tamanna, though it is a private limited company, I do understand, but the laws and labor laws are particularly applicable to private organizations also. They currently falls under the ambit of Industrial Dispute Act and the Shops and Establishment Act also. Particularly, every TCS office across every district might have registration and license under the Shops and Establishment Act from particular Labor Commissioner office. So coming to the legal perspective, yes, the laws are applicable to them. The retrenchment, if these lays off, if the lays off are done without the prior permission of the government, whether it is a private company or a government organization, they need to take a permission under this act from the appropriate Labor Commissioner office and authorities before initializing these layoffs. Once they permit the layoffs, then the company can go ahead and do the retrenchment. Coming to the human perspective of these, it is just not 12,000 is just not a number on Excel sheet or a spreadsheet. These are 12,000 jobs and 12,000 employees who are human capital to this organization. And if we are particularly talking about the mid and senior level management, these people have spent approximately 5 to 10 years or more than 10 years tenure in this organization. They have given their blood and sweat. They have given the best possible years of their lives to this organization. And what the organization is giving back to them on a Sunday afternoon, you are just sending one email to the employees that we are trying to get future ready and we are just laying you off.
No, Mr. Saluja, this is not an email to employees. They have not started the process and identifying people.
No, they have sent. They have sent an email yesterday on 27th of July.
Okay.
It is on employees portal. I have gone through that and I can share it with you as well.
So okay, so please share it. But Mr. Saluja, have employees individually started getting notices from TCS? And
no, they are saying that it is a spread over for financial year 25-26, but they have already started the process. They have put people on bench and they are pressurizing the employees they're forcing them to resign just to mitigate this retrenchment section from the Industrial Dispute Act. They are pressurizing the employees to resign on their own. They have, this is an unethical and illegal practice that we are setting up people on 35 days notice period, that within this 35 period, if you are not able to come out of the bench and if you are not able to find out the appropriate projects, then you will be, terminated from the job.
Okay.
And this is highly unethical. And one point I would like to make clear, see, Tata, just not talking about Tata Consultancy Services, the whole Tata Group is a very big conglomerate. So, I mean, for every Tata company like Tata Steel or any other Tata organization, there is a separate IT department. So for these 12,000 people, why there is no opportunity of redeployment given to other organizations within the Tata Group only?
Mr. Saluja, but this is not a government organization that they have to, redeploy people. They have a choice not to. I think what we're talking about is, and let's be very clear, we are not saying that TCS is not well within its rights. In fact, maybe a lot of IT analysts we talk to are saying this is great for those who hold the stock, because this means the balance sheet will be healthier. But there's a very real human cost as well. I'm trying to understand from the jobs purview. And let me come back to you, Ms. Dati, and a reaction, if you can, give to some of the points that Mr. Saluja made. The way this has been done, do you think there's a requirement to understand if there were enough attempts at reskilling? Because clearly, a company of the size of TCS will have to continue to hire people with talent. We've heard that again and again. Specific talent will be required. Should there not be an attempt at least to reskill those who are existing within the organization and see if they make the cut?
So, Tamanna, to our understanding, definitely attempts have been made to upskill their existing employee base. Otherwise, this number would be much larger. So right now we are only talking about 10 to 12,000 numbers. So if not for the internal L&D programs conducted by these large IT services, the number can be much larger. Also, I want to highlight the fact that almost after 6 to 7 quarters in a row, this is the first quarter where we are seeing green shoots in terms of new hirings being done for IT services companies. So this includes TCS, Wipro, and other large IT services companies. So that means they also have started hiring new talent, definitely at mid and not much at senior level, but definitely at entry and mid level. And to accommodate this cost, maybe they have to take some amount of restructuring in existing base. I completely understand the implications that it will have on the employee side, but in terms of organization, to some extent, they have made efforts in upskilling their talent base, and now they also have started hiring new employees.
In terms of the demand that you're seeing for talent within IT companies, has the requirement changed? Ms. Dati, has it changed? What does this mean for those who are right now preparing themselves for these jobs?
No, in terms of hiring, the numbers are much lower what it used to be 2 years before, before this overall IT headwinds. The numbers are still very small, but it's a good recovery because, as I said, almost after 6-7 quarters, we have started seeing some green shoots. And in terms of skill set, right now, they're largely at higher end skill set, and mainly areas like cloud security, AI, ML related jobs, and niche technologies, new age technologies is where we are seeing jobs. The traditional coding and DevOps, we are not seeing that many new open positions at this stage.
So then my question to you, Kamal, is what happens to all of those coders who are training out there? How does this work out? And my question there for Kamal Karant, how does this work out? And going forward in absolute terms, will companies just need much fewer people to do the same work in terms of IT companies?
Maybe the indicator of most of the companies that we speak to is that we might need lesser workers going forward. But when you look at the open jobs, Tamanna, out there, we're looking at a steady number of IT open jobs. And specifically, if you look at the last 6 months, we have seen a kind of a stagnation of open jobs. In fact, what used to be almost 122,000 tech jobs that was open in, let's say in Jan, the June numbers are at about 1 lakh numbers. So you can clearly see that, it is sort of coming down. So that's one part of it. But you still, on the positive side, if you see, you can still say there are 1 lakh open jobs in the tech sector. 65% of them are from IT services companies. So I think if you look at the overall job openings out there, clearly there is a space for people who are getting, let's say, retrenched for an opening out there. But there again, if you look at the mid to senior level, the IT services industry, especially the top 6, if you look at the top 6 of, say, the Infi, TCS, LTI, TechM, and HCL kind of companies, collectively have a very large number of people who are above 15 years experience and above. Now, just looking at the numbers as you're speaking, so the 10 years and above numbers are in the range of almost 5 to 6 lakh people. So there is a fair number of people whom you can say are experienced and mid to senior level, and that could be an area of concern, and that many jobs commensurate to their experience and maybe skill set may not be available in the market, and that could be a concern. As far as people who are younger, the number of job openings for them, between the 4 to 10 years experience range is still higher in the market. It's a challenge for freshers, people who are studying computer science, especially, if you look at 2.5 lakh engineers are passing out with computer science qualification out of the 8 lakh engineers who are passing out. So there is a bit of a worry because the IT industry last year absorbed about 1 lakh of freshers. Looks like the numbers could be a little less than last year. Yes, a bit of a worry if you ask me.
And what are the fees these people are paying to get those qualifications? Those computer science courses are not closing overnight. They're going on churning out more engineers who may not be required in that larger number. Mr. Ashank Desai, you started by striking an optimistic note on what happens to the industry. What happens to the workforce of this industry, the lifeblood of this industry? I think you're on mute, sir.
I'm sorry. Let me answer you the question about keeping employee ready for tomorrow's technology. All of us have trained 70-80% of our people in AI, cybersecurity, and cloud areas. So it is not that we have not made everybody ready. We spend tremendous amount of time, money, and effort as an industry compared to any other industry in terms of training people, because that's the cost of doing business in any case. And that happens. When that happens, please also realize that there are certain persons who may not be able to cope up with some of these changes. So one has to look at the overall workforce that we have and how many people can cope with the changes, etc., etc. So that's one point. Coming back to your question on the scales, see, I think this AI issue has an impact is one part. Do you want to discuss that, or do you want to discuss the uncertainty because of demand issues in the economy?
I want to discuss the people. AI issue is now blue sky, right? You have maybe some people saying it's not AI, maybe it's headwinds, maybe it's Trump's fault, maybe it's tariffs. What about the people, the lifeblood? You are churning out people for jobs that are no longer existing or do not matter as much to the largest company in this space. Isn't that a red flag, an alarm bell, Mr. Desai?
See, again, as I said, I take a very long-term view of all of this.
Okay.
Last 30 years, 40 years, there has been a constant churn of skills required in the industry. I come from area where we were doing punch card for doing programming. I'll not go there. But the point I'm making is this change in the skills required is nothing new. We continuously train people all the time. There are some people who do not get trained so fast, they remain behind, but they continue in the industry or they may go to some other industry, so on and so forth. So I'm saying what is happening is not something catastrophically new. Yes, we have to be cautiously looking at the impact of all these changes, and we are looking at it, A, by training our people so that they are ready for tomorrow. 2, restructuring ourselves to meet the structure of our whole industry so that we meet the customer demand. Please remember, we serve all 500 Fortune companies as an industry, FTSE industry, so on and so forth. We need to meet their demands.
No, of course. You need to meet customer demands, shareholders, run the company completely. Just a quick word from Mr. Saluja. You've heard all of the commentary. This is changing times. It's going to happen, Mr. Saluja. There's no point blaming the company for what is inevitable.
There is a strict need of stringent labor laws, I believe, because if we are talking about numbers and profitability of the organization, I do personally understand that they have opened a company to make profits only. But the thing over here is, if you are making profits and in May only, if your CEO salary is going and it is getting raised by 4.8% or close to 5%. You're taking 26 crores of rupees per year as your remuneration. Then why, when it comes to increasing the profits, the employees in the mid-level management or the junior level, they are taking the hit of this? Why only the layoff is the only possible solution that is visible to the organizations when it comes to cost cutting? See, we need to have a human perspective also to it. We need to add some sort of human perspective that these are the employees who build the organizations. These are the employees who stand by the organization.
There is no doubt a huge human perspective. But maybe this is just a starting of a problem which needs a comprehensive solution, because
absolutely,
because like I said, this has a ripple effect, right? These are the jobs that provide salaries to boost an economy. And then if that dries up, then where are we going from here? I'm completely out of time. I will have to thank all of you for joining us on this special edition. We'll continue to track the story very closely right here on NDTV Profit. There's a stock impact. It means a lot to investors, workers, companies. Are mid-cap IT companies taking the boost ahead, and have they planned better? All of these questions will come up. Another question is also that these companies, the large IT companies, are very cash rich. They provide great dividends to their shareholders. Should some of that have been invested in better AI preparation? All of these questions will linger for many, many days to come. That's all the time we have. We'll take a very short break. We're back with all the latest business news on the other side.
हेलो, बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है?
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
Hello and welcome to NDTV Profit. You're watching Know Your Company. Today on KYC, we are looking at Lodha Developers. The reason why we've picked a Lodha Developers is on the back of Q1 earnings, a good set of numbers that the company has reported on a year-on-year basis, but a sequential decline that has come in here. I'm Hiral Dadia and with me is Mahima Vachrajani. But let's quickly address why Lodha Developers today. Firstly, what has led to the sequential decline that we've seen in terms of where earnings are concerned? On point number 2, the other question that we will ask the management is about the India-Pakistan war. The management has indicated that this did lead to around 2 weeks of downtake in terms of execution. So how much is the impact in terms of quantifying it if you have to look at the financials? On number 3, you're talking about the first quarter FY26 pre-sales. That number is below the guidance. So what does this mean? Will it mean that they will not be able to meet that FY26 guidance as a whole or not? On number 4, the auditors have flagged non-compliance for NCDs. Now, what is the impact? Because here, you're talking about the security deposit that they have to leave for the bondholders or the debenture holders, that is not in line with the security deed. So what happens then? And the competition that they are seeing in the Mumbai metropolitan region, you have a lot of other developers that are coming in. The strategy, what they are going to look at in terms of Bangalore and Pune also is going to be crucial. And very lastly, FY30 guidance, what are going to be the key growth levers that you should be watching out for them to meet this guidance?